Take a step back, look at the situation, and say that it's no longer worth it anymore. You don't fail until the moment you raise the white flag and say, I cannot do this. Because if you're out there, if you're changing, adapting, stretching yourself and your abilities, if you're seeking help, mentors, learning, growing, embracing the struggle, being relentless in your effort, no one can bring that word into the conversation. It cannot exist. If you are moving forward, you are not failing. You cannot be working towards something and failing at the same time. It is impossible. You can have your ups and downs. No one will refute that. You can get knocked on your ass, have moments of fear and doubt, but that is growth, not failure. Growth is taking the uncomfortable and adapting to it, overcoming the obstacles that inevitably get in your way. Failure, on the other hand, is deciding that growth is no longer worth the sweat. Because I'll tell you what, there's always a way to win, and I truly believe that. Sometimes the cost is extreme, sometimes the price is more than everyone around you is willing to pay, but that's a conversation that you need to have with yourself. Just know that if you want it, somewhere there exists a solution, and knowing that is the beginning of greatness. It is the start of success. And as for that question, what if I fail? Here's some insight. That thought is wasted time and it is wasted energy, because as far as your goals go, you pull the strings. You are the writer, you are the director, and you are the actor. Failure only occurs when you write it into your script, when you choose it for an ending. And it is one ending, one of many. It is one approach of many. Once you've started that march towards what's important to you, do not let failure be the choice that you make. Choose growth. Choose the adventure. Choose the long way home. Victory over defeat, the uphill climb over regret. Choose to move forward when most wouldn't. It's the decision you'll always be thankful you made. I once heard a metaphor that our existence is like standing behind a curtain with tears or holes, and reality becomes which holes we decide to look through when we're peering out at the world on the other side. What do we want to see? And this message, well, it's for whoever out there feels like giving up or folding their hand. Whoever's been waiting for things to change but only sees the clock moving forward, this is a reminder that the very thing you need is on the other side of that curtain. And you don't need to change who you are. You just need to position yourself to see it. Because it's there and you're ready. When life hurts, we might have every reason to be in pain, to feel lost or confused, but I always find it to be a beautiful reminder that we also have every reason to seek out from that pain something we've never been before. Why is it that our greatest accomplishments come when our backs are to the wall? Our greatest acquisitions after losing something dear to us? Why is it that we find ourselves and our way only after being lost? I've never heard someone say, thank God I never changed or left or tried something new. No, it's thank God the adversity forced upon me the courage to evolve into something more. pain is to our potential what water is to a seed. It's the beginning of everything, unshackling, opening the gate, and making us realize we were sitting on the answers. That adversity doesn't stop you, it makes you stronger. That the down times lift you up. That when you lose yourself, you find a part of you that can now become the bridge to your future. See, I understand that things are difficult and challenging. I understand they're not easy, and I'm not asking you to pretend it's not happening or ignore it or close your eyes. I'm asking you to find, amidst all of this, that one thing that will get you to tomorrow. I'm asking you to find the courage to say, yes, this hurts. Yes, I'm stretched thinner than I've ever been, but I'm still going to find a way. I'm still going to make it happen. Because at the end of the day, you won't remember what hurt or what stood in your way, but you'll remember what you did about it. You'll remember how you arranged those pieces. How when your instincts said run, you stopped and built something you'll never forget. I often ask myself, what differentiates those who wish for better outcomes and those who do something about it? What separates the dreaming from the progress and the wishing from the reality? Sure, life is complex. There are a lot of moving parts to understand. But I think this element is simple. Those who build things in life are willing to not only see a reality that hasn't yet materialized, but they also understand that in a world of no, they have to be the yes. They have to believe in their ability to drive towards finish lines that no one else sees. And see, meaning cannot come to fruition without that discomfort. Or as Nietzsche put it, one must still have chaos in oneself to be able to give birth to a dancing star, and that's just it. Most people see what is, most people conform, they do not create. To change something means you have to be the metaphorical eagle amongst pigeons, flying above all that, everyone, everything else. Superseding the limiting beliefs that shackle others to their one-dimensional realities. But most importantly, it means you can see. You can see what no one else can. You have line of sight to what no one else understands. See, in this world, no one walks up to you on the street, puts their arm around you and says, hey kid, that dream, follow that, because I can tell you're going to do big things. No one says, hey, that business idea, you're going to thrive next year, I know it. That relationship, it's going to happen. That level of fitness, oh, I can see it already. Nope. People see what's right in front of them. And as it pertains to you and your world, your life, people are those pigeons. And so that leaves you with a choice. Do you accept that? Do you blend in, take the scraps you're allowed to consume, the crumbs laid out in front of you? Or do you step back and acknowledge that this is going to be tough, this is going to hurt, it's going to push me further as a person than I've ever been pushed? But you know what I get in return? That view. I get to live above the clouds with those who don't wait in line. No, they become the main attraction. They transform what is into what will be, because the world, it has a way of ensuring that we really want what we say we do. Greatness in any area of life is reserved for those willing to carry forward when most would turn back. To build a bridge to something greater when most people point out that your bridge is not connected to anything, that it's a waste of time, it's trivial, useless, irrational. Good. Changing your life in the world around you has to be irrational. Taking the status quo and shaking it, saying I'm going to alter this landscape, is irrational. But from irrationality comes the future. So when you feel like the world is against you, when you have an uphill battle to climb, when there are a million reasons for you to turn around, understand that this is nothing more than an indicator that you are right where you need to be, against the current, bringing something new to life. See, if it were easy, it would already exist. But changing your life, that makes you an architect of the unseen. So build. On the days you want to, build. On the days you don't, build. When they understand, build. And when they assume you've altogether lost your mind, build. Sure, it's not easy, but it's worth it. And when tomorrow comes, and it looks a lot different from today, when you've grown, evolved, transformed, and you look back and don't even recognize the person you once were, that won't be because you listened to the chirping of the doubters and the naysayers. It won't be because when strangers told you to give up, you packed your bags and went home. No, it will be because you rose above all that. They saw empty space and you saw a world undiscovered. They saw your head in the clouds while you built those castles in the air. You were always on a trajectory to something greater. You didn't need to convince them. You needed to convince yourself. To unlock the shackles and take to the sky, leave everything that once held you down behind. This isn't about anyone else. It's about the conversation between you and the horizon that awaits. There have been times in my life when I've been down. I've been out, I've been afraid. I've looked up at the road ahead and been completely unsure. And I can say firsthand, when you're going through a situation like this, that it essentially consumes you, right? It's all you see, it's all you think about, to the point where the good stuff, the opportunity all around you, it becomes transparent. You see right through it. It's the negative, it's misfortune for a period of time that becomes your narrative, becomes the story. What if this is forever? What if I'm not as good as I want to be or as they are? What if things don't work out? Never mind the fact that you've been here before and you've battled back. Never mind how far you've come. No, that takes a back seat to the discomfort that we feel right now, and that's the irrationality of the human mind. We forget. We forget that the lows create the highs. That temporary isn't forever, that you can't stand with any type of authority if you've never before fallen. Accomplishing anything, type of authority if you've never before fallen. Accomplishing anything is never just walking up and reaching a goal. It's about getting back up over and over again. Taking the bad breaks in stride and seeing the losses for what they are, necessary. What if I told you that the difficult times weren't just manageable, they were what you needed Those moments when you felt helpless were a bridge to something better. A demonstration of just how capable you are and how strong you can be. Feeling lost, feeling defeated, sure, it's unsettling. But it's also a reminder that you are exactly where you need to be. In one form or another, your struggle becomes your answer. Life isn't always calm seas and sunny skies, but if you let it, it will teach you to weather any storm to come out on top. Never lose sight of the opportunity, it's there. Hiding behind the struggle, immersed in the ups and downs, and when you know that you will not let yourself stay down, that you'll get up. Struggle becomes a building block, not a weight around the ankles. With each stumble, you become taller. With each misstep, you step forward. The problem will never be tough times. It will be refusing to find that next level for fear of their materialization. Regret is a choice. And for those who refuse to stay down, it will be a choice that they'll never know.
Welcome, everyone, and wonderful to have you all here. I always enjoy those presentations just to get everyone in the room, a bit of motivational. So we've got an incredible webinar tonight. We've got some incredible guests from all around the world, and I really look forward to sharing and getting everyone's insights. So let me just get the screen up here for you, and I will share it. Welcome to all our guests. It is absolutely amazing. So what we're going to be covering tonight is the global capital markets. And again, tonight, depending on what jurisdiction you are in the world, just chime in the chat box. Where are you from? It's always fascinating to see if you're playing global monopoly, where everyone's coming from. But ultimately, this is about diversification. We've got 4 authorities from 4 different continents, multiple asset classes. Come and join the conversation. I thought I'd have a little bit of fun just to go and sort of locate where we're talking to everyone. So we've got Judd coming from America. We've got Peter coming probably from Israel. Peter, you'll have to confirm, but representing Germany. We've got Anthony. Anthony, I never know where you are, the world. So I don't know if you're in Hong Kong at the moment, but and if you are, it's really late there.
I'm in Hong Kong.
In Hong Kong. So, and representing sort of Asia side. And then we've got Anthony and Garth and myself from South Africa. So if we look at a world map, that's roughly where we're representing on this world map. So before I get started, I always ask for this question. What would it mean to you in 12 months or less to be earning at least $5,000 passive income without any hassle or complexity? And how would you like a system which will statistically help you get there 5 times simpler, safer, and faster? Meet Jordan. Jordan's a high net worth. Ultimately, he's run his own business. He's worked very hard for his money. He wants to build his portfolio and ensure that his wealth is preserved. He wants to build a globally diversified income of $5,000 a month, $10,000 a month, maybe even $25,000 a month, simply and safely. He wants to diversify his investments between countries, currencies, and assets. He wants to use his limited time to get effective results with predictability. He wants to save decades of frustration and millions of dollars to get the right knowledge for him and his family. He wants wealth protection, a plan B, and peace of mind. He wants to be held accountable and have an accountability partner. He wants a family office to help him manage all his affairs. He wants to create generational wealth for his family. He wants to have a fully completed wealth plan and investor strategy sheet. And he wants to get results. Now, who here resonates with Jordan? Because this webinar, this panel has been built to try and help people like Jordan achieve their objective. What about Victoria, an entrepreneur in her 50s devoted to her family and business, aiming to build generational wealth? Victoria, despite a packed schedule, seeks a streamlined investment strategy that empowers her to make wise decisions, aligns her with her goals, and frees up her time for her grandchildren and daughters. She understands the investment landscape, so she feels empowered to make the right decisions for herself and her family. Victoria focuses on achieving financial freedom to cherish more moments with her loved ones. Again, who resonates with Victoria? So what is tonight all about? It's about living a life unlimited. And how do you do that? Through diversification. And if you want more detail and to go into a lot more detail, we do run a challenge. It's a 5-day challenge. And the next one is actually on the 29th of July. So you can just go to that link, diversificationchallenge.com, and you'll be able to sign up for that. We've also got a masterclass next week. If you listen to people today and you think, wow, that's only for the super wealthy and the super successful, and you want to actually learn from real people with real stories, we are doing another session next Tuesday where you can come along and meet them. And then finally, in terms of a Q&A, we will be running a Q&A afterwards where you can ask any questions that you're interested in. Some people kind of get a little bit confused and they're not quite sure what to do next. So if you are interested, go to our navigator. It's a digital system to help you navigate what the best next steps are for you. So literally go to wealthuniversity.org/next, and it'll help you navigate. Now, when it comes to investing, we always say there's two things you need. You need the right information and you need the right partners. A great example of this is what Anthony provides our mastermind members every single month. And he takes them through asset allocation and what is actually happening with the different assets around the world. And just last month, he was talking about what's happening with regards to AI and the massive investment in AI infrastructure, what's happening with unemployment numbers in America and the impact that's going to have on inflation, and also what type of major events around the world have occurred and what has that meant to the markets. So it's just a classic example of having the right information so that you can make the right decisions. And tonight, I'm super excited because we've got 5 partners who are actually joining us. Firstly, we've got Judd coming live from America. And Judd, I know you've got probably the most interesting story of everyone because he's flown to do a closing. So in America, a closing is a transfer where you basically buy a building. And I tend to joke with people, we don't have Harvard professors that have come to share their wisdom here. Judd is literally on the ground. He's going to be running this webinar with us. He's then going to be going to the bank to wire the funds to do a closing. So Judd, welcome to you. And thank you for real time helping us in the middle of a closing.
That's great. Can you hear and see me, guys?
Yeah, we got you loud and clear. Yeah.
Okay, great. Well, I'd say right here is about the that's about the essence of where we're at. So I'm here with Steve. So Steve's you didn't know you were going to be on there. So we're walking his physical plant. It's a 75,000 square foot. It's been around for over 100 years. They do Hellfire missile skins and they do electronic containers and lots of different metal and machinery, which is really the heartbeat of what we do in this not sexy asset class industrial, right? So we're on the site here in Columbus, Ohio. So thanks for having me. Literally flew in to close this today, going from here to the bank, finishing our documents and closing with all of our investors. And, we've had your group invest with us before. And, it's an honor and a pleasure. So thanks for having me, guys.
Awesome, Judd. Well, thanks. I'll come. I know that you've got a tight time scale tonight, so or today. I'll come back to you, but I just want to welcome everyone else into the room. So Judd literally coming live from the warehouse. He's buying the industrial warehouse. He's buying this afternoon. Garth's actually joined with his partner, Anthony. So Garth and Anthony work very closely together. Garth is the founder and CEO of Callio Capital, and they are the family office that we have partnered with. So both to Garth and to Anthony, welcome. It's always a privilege and an honor to have you. And, as partners with us in the mastermind, you continue to add tremendous value to our members within the mastermind community. But thank you very much for being here, both of you coming from South Africa at the moment.
Yeah, I'm going to jump in first. Hi, good evening, Scott. Good evening to everybody that's in and listening, and to Judd, who looks like he's getting a lot of exercise walking around that 75,000 square foot. Being South African, I don't know what that really means or what I've got to divide by to get to the square meterage, but it sounds impressive, Judd. Anyway, it's great to be here, and I hope we're going to have a productive discussion. And evening to all my partners that I know very well, and a special shout out to a friend who's joined us tonight, who I've been trying to get to join here for a while. So a special shout out to her, getting a special knowledge tonight.
Awesome. Anthony?
Evening, guys. Scott, thanks for having me. I've seen a lot of familiar names joining the participants. So I look forward to it. Hope we can add some more value.
Awesome. So now we get in a little rocket ship and we go right across to Asia. And Anthony, it's wonderful. Another Anthony, two Anthonys on the same webinar, just to confuse the hell out of me. But anyway, Anthony all the way from Hong Kong. And Anthony has actually been working with us since 2017 and did a presentation to our mastermind members in January about data centers. And when one thinks about what's happening with artificial intelligence and crypto and everything in between, we were very, very excited to have that presentation. So Anthony, firstly, what time is it in Hong Kong now? Because you're probably the one that's giving us the greatest sacrifice of time to be here.
Thank you, Scott. Yeah, I almost say, oh, I didn't really check the time. It's 7 p.m. South Africa. It's actually 1 a.m. 1 a.m. past midnight in Hong Kong. That's all right. I'm used to that kind of hours. Actually, I was in Phoenix for 15 months for the better part of last year, looking at a data center investment deal in Arizona, where the TSMC plant is. So yeah, happy to be joining you guys and learning from you guys as well.
Awesome. Well, thank you very much, Anthony, and I deeply appreciate Judd coming from literally a closing on a warehouse and you being up at 1 a.m. in the morning. So thank you very much. And then Peter, wonderful to have you as well. Peter, I'm not actually sure where in the world you are, whether you're in Israel or in Germany or in South Africa or where in the world you are.
Thanks, Scott. Yeah, I'm actually in Israel for this week, back from Germany last week. Thanks for the invitation to join you guys. I'm particularly interested in seeing what the co-presenters are going to say. Haven't heard them before, but they certainly all look interesting. So interested to hear about what they have to say and interested to weigh up, see how Germany and Europe's doing as an investment location.
Awesome. Well, it's wonderful to have you. And what we've tried to do tonight is to balance, the mixture between America, Europe, Asia, and even, Africa. And obviously with Calio, they've got a globally diversified focus. So what I wanted to share with you, and to the other presenters, I do want to ask for a favor. Judd got hold of me, and this is in this middle of the closing. So I'm going to just give 2 or 3 slides to introduce all of us as panelists. And then if you don't mind, I was going to go one question. But with your permission, if you don't mind, I'll start with Judd's questions because he's got to get on to the bank to do the closing. Is that fair? I'm sort of dancing on stage as it's happening. Is that cool?
Yeah.
Awesome. Okay. So I just want to share one thing that I think is very important before you meet with all these partners and understand who they are. There's an old school way of investing and there's a new age way of investing. The old school way of doing it is all about control. The new age way of doing it is through diversification and partnership. So if you take a building, I don't care what it is, an office building, a hotel, a shopping center, a hospital, a house, it doesn't matter. You're generally going to borrow about 60% from the bank. There's going to be about 30% in private equity and about 10% in equity. The old school way of doing it is that you want all the control. So you put at least 95% of the money into the equity. And when you look at the risk, you've basically got the most risk. On the other side of the equation, you've got the bank. You've got the same thing, the bank, the private equity, and you've got the equity side. But as investors, you only aim to put in about 10%. You let the local investors put in at least 90%. And so from a risk perspective, you've got a lot less risk. So the old school way, you've got a lot more risk. The new age way, you've got a lot less risk. Now, the old school mindset is all about control. The new age mindset is all about diversification and partnership. The problem with the old school is you've got concentration. So yep, you've got all the control, but you also got all your money in one building. So if something goes wrong, fine, you've got the control, but you have to fix it. You have to get on a plane and go over there and fix it. A good example is a deal we were involved in years ago in Australia where, yeah, granted, we got all the control, but now there's a hole in the ground in Australia. If you take diversification, you got a lot less control, but with good quality partners and local partners, if something goes wrong, then basically they will fix it. So in the old school way, you have to be a lot more active. The new age way, you're a lot more armchair. The old school way is all about scarcity. The new age way is all about abundance. And I want to give you 2 examples of this. So Judd, is here tonight, and literally we've got an opportunity available, which we're launching next week on the Migrate platform. where, you know, it's an industrial building. So when Judd is talking about industrial in America, you don't have to go to America and do the whole thing. You don't have to find the building. You don't have to buy the building. You don't have to get the mortgage, et cetera, et cetera. What you can do is partner with local Americans, partner alongside them, partner with partners like DWG, and actually be able to get access to it. So I'll talk more about the deal a little bit, you know, just now. But if you did want to go to the landing page, and Alex, if you can chuck the landing page in the chat box, you can go and read all about it. But it's a much better way of investing with a more institutional and sophisticated mindset. Another example is Peter's deal in Germany. So Peter's going to talk about the German market and the ability to get income producing deals in Germany. And once again, not only you're in Germany, you've got exposure to the euro, which is expected to increase in value against the US dollar over the next 5 years. So again, you can actually go, and you don't need to know all about Europe, all about Germany, which cities to invest in, which assets to invest in, how to get finance, etc. The reason I'm telling you both of these is that we're about to now pivot into our partners and to learn from our partners. And I just wanted to give you peace of mind that you don't have to know everything. I believe one of the easiest ways to investing, and one of the best lessons I can teach you, is that if you can meet the partners and you can understand the partners and you get the right information, then you can invest alongside the partners. So without further ado, Judd, I'm going to start with you with everyone's permission. How do you see the future of American industrial real estate evolving over the next 5 to 10 years?
That's great. First of all, I want to apologize to the panelists and say thank you for understanding of the necessity of the day. Everyone knows closings move so quickly and slowly, and then there's always drama. And why is there drama for your people at home? Because when somebody transfers real estate, there's fear on both sides that somebody gets everything they deserve, and there's that people are making a safe decision. So there's always an inherent drama that I guess all of us as your principals get to take out of the process, so you can, you know, invest at home from the click of the house, office of the house, the click of a mouse, right? Make it easy through Global Wealth. And I think that, first of all, your platform is amazing. It's timely and it's right in tune with the world. So this is interesting. This is our 10th deal. We're actually closing today, 60 million square feet, 575 million. From here, we're actually going into another element. We're going to do a fund and some legacy deals to keep buying across America. And what's happening is I've been in this industry 20 years, and you know, the industrial's always been the non-sexy asset class pre-pandemic. It would have like 10 cap rates, 20% vacancy. And now we're seeing, like in this area that I'm in here, like 1.6 to negative vacancy. So you've got demand. That what happened after the pandemic there was a lot under Trump. There was a lot of movement on onshoring, which we also know that China is having, you know, significant challenges. There's the potential of a lot of future onshoring happening right now, which is a whole different discussion. So we are having positive waves of onshoring, but we're also having post-pandemic logistics have really changed the face of our market in the industrial space. So I'm here in Columbus, Ohio. I'm sitting here with the CEO of the deal we're closing. He's letting me sit in, and doing this while we're here, kind of all covered each other. But you know, at this moment in time, Columbus, Ohio, is one of the #1 cities in the United States for growth, and there's 10 markets in a short market from here. So you've definitely had the inherent pressures in retail because of take my glasses off so I can see you guys. You have the inherent issues with retail, that there's online susceptibility. You have the crash of office and the changing of that industry, which it will recover one day. You've got apartments that are maximized out to, you know, in the 9th inning of a very mature quarter, and industrial probably in their 4th quarter here in America. And in the post-pandemic logistics space, you're seeing a shifting map about location, and you're seeing exceptional growth. And the American dollar continues to chug along and be strong, even though, you know, we have some cycles of post-pandemic leadership that are challenging. We don't have a really vibrant economic plan right now. But what we like to say this here is, like, you know, America is 10% politics, 90% Americans. So if you look at the strength of our job market, look at the strength of our recovery, our banking industry has gotten really safe. The law has changed significantly after the crash, and we've got leadership that is staying fierce upon that, and a lot of pressure on debt reduction. So, and we've also got a really aggressive inflation strategy right now. So you know, we've got 14, 15 raises from the Fed that's going to hang in place. So right now, what's happening in industrial is we had M&A merger constrained capital for business growth that has also gotten really expensive. We're in the sale leaseback space. So we provide a full debt equity cash out. The tenant becomes the owner. So in the sale leaseback space specifically, the owner becomes the tenant for us. And we get new 20-year leases. And specifically in that space.
Sorry, just very quickly. I just want to put that into English for people. So what that means is someone owns a factory and they own their whole they own the whole business. And what they want to do is they want to sell their factory to recapitalize their business, to grow their business, and then you become the landlord of their property on generally an 18 to 20-year lease.
Correct. Yeah. So a sale leaseback, whole different discussion. Go look at Airbag It, which we're launching through. It's a great deal in Phoenix. But specifically in our market, what you're asking about is what's changing and how industrial. So industrial's trends are into that. Right now, we have higher cap rates for a short amount of time. And what happened in May 2022, industrial cap rates hit an all-time low of 5.5, right beside multifamily. It was the fourth asset class. Industrial moved from the average yields just for buyers went from 9% for multifamily and 9.3 for 9.3 multifamily, 9% for industrial. It's the first time in the history of America that industrial has been the second darling asset class in America. And during this same exact period with the post-pandemic logistics changes, and this period, we've had a decompression of cap rates, but we've had an increase of velocity and we've had an increase of need because of, people just started buying online. So it's an exciting time in the space. I think we're in our fourth quarter. I think we're going to see another massive decompression in 2025, 26. And that's why we're going to buy another 100 million in the next 18 to 24 months. It's what we call once in a lifetime, like generational opportunity here. So that's a quick snapshot of what's actually happening here. And just to let you guys know, I'm a 20-year vet from 3 different corporations. And, I've sold every asset class in 37 states. And it's been an honor and a pleasure to be here. So I do know the market pretty well, and it's an exciting time in the industrial space.
Tell me, Judd, in terms of some of the risks and opportunities, so in this industrial space, things like how do you manage the risk of the tenant defaulting? Because one of the key risks is obviously you've got a single tenant. How do you manage the risk and equally look at the opportunities?
Yeah, that's great. So, the bank we have to put in our space, we have to sign the personal guarantees. So we won't buy anything that would fail, right? I mean, we do about $20,000 of credit risk and probably about $50,000. So I have people from Stag, VREIT, and STORE, some of the major companies. So we have a professional credit risk analysis team. Then we have site analysis. And then we go, and then the banks will come in every 3 months and they'll say, hey, Judd Dunning, DWG Capital Partners. They look up I don't want to say a different term. They look at every detail in our life and every 3 months and annually. We do the same for our tenants. So we're checking in on tenant health. We're looking at their structures, their plans. We talk to their CEOs. Occasionally, in the past, for a very large firm with $1 billion of assets that I helped build, someone else's company, we will, bring in PE if needed. We've had distressed situations, and we'll get in there and restructure. We haven't had any of those issues here with our company, but we're seasoned helping other companies. And then you can always bring in capital, you can restructure business, et cetera. You don't think, these are triple net leases. We call them mailbox poppers. So for like 6 months before you close an industrial, you're working on the terms, you're working on the leases, you're working the sale leasebacks, whether it's you're checking out your add value strategies. Like before an investor sees a package, it's usually, hundreds of thousands of dollars of spent in, hundreds of hours.
And where does the opportunity lie?
The opportunity lies right now in the arbitrage, because look, the bottom line in industrial right now is that you're buying this building here, like $50, $60 a square foot. You couldn't build this for $180, $150 to $180 a square foot. So you're buying below replacement costs. So that's fundamentally sound. You're buying escalations that are at or in excess of inflationary caps and targets. So you're seeing escalations 2 to 3%. So you're staying ahead of inflation. You're also seeing cost segregation. If you've seen me walking around, when you buy these assets as the owners and partners you can cost segregate. If you're an American citizen, you can cost segregation on those taxes. And also you'll see that rents right now are pretty low during this growth period. So you've got good rents in place. And then lastly, the biggest opportunity is the arbitrage between cap rates and debt. Right now, debt is high. So we have to use something called structured finance. And I'm sure a lot of the other sponsors can relate to this. You might have to put in a little bit more working reserves or capital so you could deliver a good monthly yield and level out the difference between debt and the cap rate until like 3 years from now. Now, there comes the big rub, Scott, which I think all of your other sponsors and partners will agree with, is why do we know rates are going to go down? Well, out of the last 10 turns, the Federal Reserve has lowered their rates 190 basis points in 29 months. And if it's higher for longer, what does that mean? An extra year? So if it's an extra year, let's say there's a crisis, what happens? If you look at the Gulf War recession, the dot-com bust, the Fed has reduced 15 raises in the same speed downwards that goes upward. So we do not have a contaminated legal system. We do not have a contaminated governmental system that can actually alter the structure of the Fed, which lives outside of politics to the greatest degree, like 80–90%. So, historically we do return, and we don't have any fundamental black box information why our economy will collapse. So we've got a really straight line that when debt reduces, cap rates will recompress as they always do. And therein lies the opportunity. The arbitrage between debt and cap rates and the cycle of this asset class. And every cycle in every asset class. That's the fundamental real estate that you're teaching your people to invest in. I'll end with this is like, the great opportunity, like this is first time stuff, the structure you've created, Scott. People can come in at limited amounts and invest through sophisticated sponsors to pass on institutional theory and gains through democratized capital. It's a really exciting time, and we're honored to be a part of your panel.
Awesome. No, thanks, Judd. Last two questions for you, and then I'll pivot. The first one is the whole triple net lease approach and kind of in the industrial sector you're in. Why is that unique, and why is that representing an opportunity for investors? You've given us the investor opportunity per se in terms of where we're looking at, but why triple net lease specifically? And I'm specifically just for most investors, like they think, that mom and pop mindset, they go out and they buy houses and they have to fix toilets and all that sort of stuff. What's the benefit of a triple net lease?
Well, what is triple net, right? It's the utilities, the taxes, the insurance, and the repairs. So the concept mailbox popper. Now, how do you add value if you're not doing anything to the property? For us, we buy right, and then we take the tenant's current income, we make it into a bond. It's like a 20-year lease bond. So we create boxed income. So we're actually doing all the heavy lifting. There actually is changing toilets, but what we're doing is we're getting rid of people's prior debt. We're recapitalizing them for growth. We're figuring out where they want to restructure the ownership of their entities. So we do all that through the sale leaseback. So it is like fixing up a property, but we do it before they close. And when we close, it's an absolute triple net lease. No have to worry about taxes, insurance, repairs, anything at all. It's just they pay their rent, we pay our mortgage, and we pay our partners.
Perfect. And then my last question to you is, America's a big place. I mean, there's 300 MSAs, metropolitan statistical areas, cities basically for people. You live on the Californian side, the West Coast. Where are you looking and why? Which cities and why?
Great. I actually also live in Texas, so I'm like 50%. I just claimed residency a couple of years ago, so I'm 2 weeks there, 2 weeks there. I am agnostic on America. America is a powerful and amazing country. I mean, we have all the benefits of, and without hubris, right? For those around the world, I think a lot of people might think this is, simplified to America is great, that whole concept. It's not that. We are very fortunate. We have landlocked, democratized system with great resources. We're in the perfect time in history. So there's a lot of benefits to how our legal system relates to our free market system and our property rights. And our state structure is like, let me get back on the screen. We have the variance of different cultures and different drivers throughout our country, but we're not separated as a country. So we'll go anywhere where there's good growth. You can look at it really, the last deal we did, JAL, it was South Bend, Indiana. Before the pandemic, it wasn't a place you'd really go. It became a top 10 residential housing market. So the freedom of our to go interstate in our country, it's different countries and economies and drivers, but we're not restricted because we are under a federal government, but we have our unique identity as states. So, any area that becomes in the path of growth and hot and preferable, we're interested in those markets, and particularly post-pandemic growth markets. We just got Phoenix. Phoenix became, from being an isolated kind of desert economy with some highs and lows, it became one of the best industrial drivers in the United States, top 3 growth market. We just invested in Austin, a #1 market, Columbus, #1 market. It doesn't have to be that. You can also invest in the middle of nowhere, but make a great move in a great company with great credit, and that credit could be bought by a bigger company. You can make a lot of money in tertiary America as well. But if you're going to go tertiary, you want to make sure you have the credit. So the credit, there's 2 things that guarantee that protect it: the credit of the asset itself, the credit of the asset, and then also the location of the asset. So every time we buy, we look at those variables and we try to make the most intelligent decisions so we can hit the highest IRR in a 4 to 7, 3 to 7 year hold for our investors. And I'm sure all of the sponsors here, the basics of what we do are the same. Ultimately, you come in for a hold period, you have intelligent people that maximize and lead the investments.
Awesome. Well, Judd, thank you very much. I'm sure it's time for me to share the love with everyone else, but I do laugh at you being in an industrial building. I've never quite done that.
Yeah, before. I hope it was seen as a positive to your people, and I apologize if it's kind of in the middle of the club. I really am going to the bank to send out a couple $1 million right now.
Well, thank you very much for being online, and good luck with that closing.
Okay, great. I look forward to meeting the rest of the panelists more in the future, and thanks to you and all your investors. God bless. Talk to you soon.
Cool. I'll connect you guys. So Garth, I'm going to pivot to yourself, and then Peter, I'll go to you, and then Anthony, if you don't mind, I'm going to go back to how I originally planned it, which is sort of 1 question each, and we'll kind of rotate around and have more of a panel discussion than a one-to-one. So Garth, I think for me, one of the things that I've always been fascinated talking with you about is kind of what are the major investing trends globally? And particularly, as a family office, you get to deal with some of the wealthiest people from around the world, and you get the best advice from all over the world. What are the big trends that you're seeing that we investors should be thinking about? And I know you and Anthony are pivoting, so if you don't mind, I'm going to ask you, and if you need to ask him, then you just fire away.
Yeah, thanks, Scott. I don't think I'm going to be as fast-spoken as Judd. I'll probably be a lot slower and calmer like a South African, the good old American way. I do enjoy the energy. It was fantastic. Look, the major trends, I think you alluded to it about the new age and the old way and the control. I think the symbiotic investing and a lot of the family office joining forces to buy assets outright. Typically people have moved away from the institutional and the stock standard market investing, capital markets. And the trends with the big high net worths is to be involved directly in that action and to be involved directly in the asset. And by being involved, seeking the expertise of the family office partners, with Kalia, for example, like Peter Katz, one of our partners, the importance of having expertise in that partner and tried and tested. And when you look at wealth, I mean, we've had, great wealth created in the industrial revolutions. We've had great wealth created in the digital era. But I think if you look at land ownership, it's always been a consistent asset class, and property by its nature, a very consistent asset class to protect and create wealth. So in a family office, we're seeing a lot of move back towards property and diversification of global property. And talking specifically to America versus Europe, there's a lot of talk about America losing the power that it's had, and I don't buy that, and I do agree with Judd on many, many aspects. So I think people's diversification is largely focused around where assets are cheap and the fallout from the interest rate and inflation cycle. So excellent partners like Peter, like the Judds that you've got here, being able to identify those distressed assets and to rejig those assets is a very, very strong focus. We're also coming out of, a period where we've had geopolitical tensions and we've had considerable, negativity in the markets. I mean, even though 2023 rebounded considerably, I still think, people have been very nervous coming into this year. So people are starting to take a hard look at it, and we've got incredible optimism in the market. And it's not that end of the bull run optimism. This is real optimism fueled by the cycles that we're facing and the inevitable decreasing of interest rates. That decreasing of interest rates and that optimism, in my view, is where we're going to see the dollar strength coming off, and why we're looking specifically not just at the USA, which is typically your biggest property player, why we're particularly fond of the European space and particularly Germany and the euro-based incomes and IRRs, the growth that we can get on these assets, is attributed to the fact that safe haven dollar and the strength of the dollar being above its average strength. So even an equalization of the dollar back to an expensive or even a midline, people are looking to the other currencies to diversify their assets. So if you look at a European asset increasing from 5 to, let's say, 7% in the next year or 2 or 3 years, as an income from a European asset, a euro-based asset, or a sterling asset, that is effectively an increasing yield against what could be a decreasing currency in the dollar. So that's why I'm a big fan of the European incomes generated from properties and the IRR on that. I think America's had a strong run, particularly the two asset classes alluded to there, not so much the industrial, but the multifamily. I think that in the US is constricted quite heavily. And I think the retail space in Europe is stronger than the retail space in the USA. So I'm a big fan, and having just come back from London, it's good to see the cranes swinging and the properties moving again, which was a little quiet over the last few years. So yeah, that's the trend. Family offices and particularly the high net worth grouping together to own the assets outright and to use the expertise of partners, and moving towards property as a key anchor in their diversification strategies. Anthony can talk more to the listed market, the tech space, the Magnificent Seven now, the Magnificent Six, and the earnings there, which obviously we remain focused on. But yeah, in a nutshell, I think that's the dominant theme across family offices.
Do you mind, Anthony, if I pivot to you on that technology piece? And we will do that, but if you don't mind, I want to go to Peter because it lines up exactly with what Garth was just talking about. So Peter, I've been whether it's Garth talking or Anthony talking or another gentleman, I think you've actually seen him before, James Painter. He talks about this euro increasing against the dollar, and yet I've been trying to get into Germany or even Europe for the best part of 20 years and have not been able to. And between Garth and his team at Kellio, we tried to get in 3 years ago, and it's a lot harder to get into Europe than people think because we don't speak the language, we don't understand how the laws work, et cetera, et cetera. So I'm super excited to have you here. Maybe just explain a little bit of your background in terms of the European market and specifically the German market, because I think it's really important when you take what Garth just said, to understand the caliber of the person you've got on the ground that can be unlocking that European and even more so that German income producing opportunity.
No, I fully agree, and everything that Garth's saying resonates so much. I'm investing very much for the family office space, and I'm very much investing for a investment philosophy such as the Jordan, who you introduced at the beginning of the podcast. So let me just say, I'm a lawyer by background, but I've been involved with property investments for the last 20 odd years. And all of those 20 years have been in Germany. The reason we went to Germany is I was with a REIT, and we had really a whiteboard as to which jurisdiction to invest into. There were some sexier jurisdictions at the time: Eastern Europe, Romania, Scandinavia, all of that type of sexy stuff, which were given tremendous returns, Romania as well. But we wanted to almost be a bit of a Toyota. We wanted to be able to perform year in, year out. And we wanted to try to the best we can achieve the holy grail of both income return and capital appreciation. And to get both of those right, we were looking for political and economic stability. We were looking for an environment where we can get long, stable leases. And on those three fronts, Germany certainly ticked all the boxes. For a variety of other strategies, we could then maximize the value within those assets, identify the downside risk and prevent any downside risk while working the upside growth and potential of the actual asset. Two more points I should mention. Germany is a very good jurisdiction. There's many other good jurisdictions as well. Clearly, the US is one of them. Great Britain's one of them. There's lots of others. There's no question about it. I'm certainly not suggesting, and I never have, that Germany is the best out there. It certainly is one of the best, and I would agree with everything that's been said. The most important thing is to back the right jockey that knows what he's doing and has got expertise on the ground. So I think that's probably the single most box to ticks, even before you get involved with what jurisdiction. The final point I'll make, and while I'm absolutely delighted to hear that Garth is bullish on the euro, I'm not a currency trader. I'm not a wealth manager. I'm not even going to advise investors what portion of their wealth to allocate to property and certainly alternative asset classes in different jurisdictions. I'm solely based and solely focused on the fundamentals of the property. So if there is going to be an added sort of cherry on the top by way of a bonus through the euro strengthening, etc., that's on the top. It's not part of what I look at. I'm focused on the fundamentals and how we can max out the value of the property.
I do want to put a big risk. I do want to put a big risk disclaimer against that dollar call. Okay, that one could come back to bite me because people have bet against the dollar in the past and been severely hurt. My point is that it's not that I see the dollar being weakened. I just feel the dollar is so overvalued compared to its midline. So the probabilities, I always work in probabilities. There's more probability of euro strengthening than dollar weakening. Okay, so I'm just putting that out there. Don't run and put your entire portfolio in euros. That's not what I'm saying.
Just quickly, Garth, that goes without saying for everyone. This is an informational webinar and panel and not financial advice. So just for everyone. So Peter and everyone, you're all covered now. This is educational. So Anthony, now I've got two Anthonys. So I'm going to start with I'm going to assume the younger Anthony, and then I'm going to move to the other Anthony. So Anthony, Garth mentioned the big seven. So let's start there, and I'll tell you why. Because this then pivots directly into Anthony NG in Hong Kong. Because you actually shared a slide literally with our mastermind members on 2 weeks ago or whatever, around AI investments, etc. And maybe just talk to what Garth was mentioning on how when you take the S&P 500, how it's just ridiculous how the big seven have driven that, etc., etc. And then more importantly, what does this mean with regards to AI, and the future?
Yeah, sure. Thank you, Scott. I'm going to assume that I'm the younger Anthony. Yeah, so it's been interesting. I think I agree with everyone and what they're saying. Naturally, my focus on a day-to-day is more towards the listed market. So I typically approach these kind of things from a listed market perspective. And like you say, you posed the question around opportunity, and I think the opportunity at the moment in the S&P 500, like you said, is certainly around those 493, 494 odd stocks that fall outside of that Magnificent Seven, or now Magnificent Six. And I think the reason for that is you've seen this massive share price appreciation in those 6 shares, namely those 3 on the screen and 3 others, but they've largely been focused in the tech space. So I think in terms of opportunity, our focus is certainly on those 493. We don't discredit those other 7, as they have been significant performance adders to any portfolio. But I think in terms of if you're wanting to narrow it down, I would start on that 493, and then I would work my way out of the US. I would start looking at Europe. Europe has been undervalued for quite some time now. They've had their own set of challenges, as has the UK. And I think we're slowly starting to see bright spots emerge there. We've seen some good data come out of Europe and UK of late. So I think the investment world is is shifting their focus back to some of the other developed markets, which is very interesting to see.
And tell us a little bit about the slide that you shared with the mastermind members in terms of this CapEx investment with regards to AI.
Yeah, sure. Sorry, I skipped that one. So what this slide looks at is it looks at the three companies below, Meta, Alphabet, and Microsoft, and it aims to understand how much money they're spending on artificial intelligence, and that's a broad category of artificial intelligence. It extends from infrastructure all the way up until kind of software development and engineers and things like that. But ultimately, what we're seeing is we're seeing massive expenditure being forked out by these businesses into the AI theme. So it's going to be interesting to see that the kind of spotlight is now going to be on the future of these businesses, their earnings results, and what this CapEx looks like in terms of translating into revenue. So it's obviously great that they're viewing this theme, artificial intelligence, as an investable theme, but the attention will quickly shift to what that means from a revenue perspective. Are they able to monetize all of this big spend into AI?
Perfect. Well, I mean, it sort of pivots into you, Anthony, in in Hong Kong at 1 a.m. in the morning, 1:30 nearly now. And tell us in terms of the whole data center, because you gave us this presentation in January to the mastermind members. And in simple terms, my takeaway on it, and I know you can kind of go into this in more detail, but supply is constrained because of electricity. Demand is growing exponentially, every 6 months based on whether it's artificial intelligence or crypto. And what is the future of data centers, whether in Asia or in America?
Oh, thank you, Scott. Basically, it's AI is gonna drive up the demand tremendously. Even before AI, in a market such as Phoenix, you'll be looking at the supply lacking the demand by 3 years. So even with AI, it's driving up the demand even more severely. So we're looking at 2.5 times of capacity increase for the last 6 to 12 months, and that's a lot of capacity coming to the market. So when you look at data center, it is a real estate asset class, but it's an alternative investment in terms of real estate investment. Basically, it has very sticky tenants. So that means that your tenant will almost never move out of your premises, for 10, 15, 20 years. And currently we're seeing very low vacancy rates. It's all single-digit vacancy rate in the data center in America, in Europe, or in Asia. So we're seeing a lot of demand, and then I don't think in the next 3 to 5 years this demand will come down at all. Will grow at a faster pace than today. So I think the younger Anthony Dicken mentioned about AI capex spending. I think there's a report by Bloomberg that's saying that the AI market will grow to 1.3 trillion from just 40 billion in 2022 in the next few years. So we are just providing the space and the infrastructure for all these AI adaptations to be able to fit into the building. Basically we build a box with power and cooling solution so that these AI machines can churn out AI solutions for different sector of businesses. So traditionally, I think data center has been used by telecom companies, a lot of banks doing storage backup, and e-commerce doing a lot of data mining and all this stuff, and of course a lot of crypto people doing data mining and everything, crypto mining and things. But now every sector of business, they're going to use AI. Every lawyers, legal firms, medical firms, all kinds of companies were going to use data center to fuel their AI solution. So we're seeing very promising trends in the future for the next few years. So yeah, we're very optimistic in this sector of asset class at the moment.
Just in my interest, in terms of the slide that because you prepared a few slides, is there, I know you've spoken to some of these numbers, but is there anything you want me to point to with the mouse in terms of some of the stuff that's relevant here in terms of this question of what are the current trends and future outlook for data centers?
Yeah. No, I mean, this is just a macro presentation of the sector. The growth is there. I guess the only thing that I want to maybe share with the audience is that it is a very it has a technological hurdle to get into this asset class, because power is not available. A lot of markets, with all the demands of data center, they're going to be running out of conventional grid power. So the next thing is to look at how the renewable energy going to solve the demand of data centers. So that's the only thing that we're looking at. So when we identify a location for data center investment, the first thing we look at is power availability, not the land. The land cost or the building cost is going to be a small fraction of the investment versus the power and all the infrastructure that goes into a data center.
Just tell us those numbers. I can't quite remember off the top of my head, but it was something like a data center uses the same as 200,000 households use electricity per year. A data center uses in a month or something. You gave the stats. What were they roughly?
Yeah, if you're looking at a typical hyperscale large data center that uses 100 megawatts of power, you'll be looking at the equivalent power usage of 120,000 households per year, and we use it on a single month.
So it's 120,000 households, and that's the constraint, is the electricity, because no government, no politician wants to sign that off if they want to get any votes. Yeah. So that's the problem.
Yeah, if you look at Singapore is actually one of the largest data center hubs in the region. It's the largest in Asia, but because, as you know, Singapore is a tiny little space, so they have ran out of space. They have also ran out of power for data centers. They actually issue a moratorium to stop new data center projects since 2022. So a lot of that opportunity now spill over to the neighboring countries like Indonesia and especially Malaysia. So the investor will go where the power is. Yeah.
Okay, brilliant. Garth, I want to pivot back to yourself. And the question here is, from a family office perspective, people are becoming more and more diversified in terms of investments, and you have sort of already alluded to it and how people are moving away from institutional and more towards partners. But how do you see this global market diversification and investment strategies? Kind of what's the trend out there that we need to be aware of?
Was that directed at me? Sorry, I didn't hear you in the beginning there.
Sorry, yeah. So for yourself, yeah.
I was just checking a little bit of South African humor there for other Anthony. We're definitely not attracting data centers to South Africa without power. I mean, doesn't that just prove what you've got to do from an infrastructure point of view to attract foreign investment? Hence the reason, to the South African audience, why the global market is so attractive to us is, we just can't attract the foreign investment that we need. So the question there, how do we ascertain global diversification, markets, global diversification? What was the question there? Sorry, I missed
So
it.
in simple terms, how does Calio approach global market diversification in its investment strategies?
So, you know, first of all, I think one of the most important things about a family office is you are preserving wealth. So there's two sectors. You've got wealth creation, you've got wealth preservation. You know, a family office is preserving wealth and it's looking at preserving legacy. And when we go into these, you know, the trends and what we've seen in the world where wealth is created very quickly, like the digital era, like AI, it's created very quickly. It's not often understandable to the everyday person. So the first thing about global diversification and how we go about it is, number one, that family offices and wealthy families have really started to take on. I mean, we're up to around 35% of high net worth families taking on an independent investment committees. So we're finding more and more our employment in the high net worth families is that specific subject. How do we diversify? So diversifying is a function of yield requirement, okay? So in a portfolio, you've got an income requirement and a sustainability of a lifestyle that needs to come from that capital wealth that a person holds. So when you go into diversification, it's not a case of just the fundamentals or the economy driving that. What is really driving it is how much of that capital is required to produce an income. When you look at income, you've got to produce income from asset classes that are understandable to the family and to the investor. Not for us. I mean, we can mumble off about, you know, discounted assets and, you know, ways to make money that are just way over the head of a lot of people. So the diversification is plan-driven and time-driven. Risk-driven, how much risk do I need to take to actually get the result that I want to get? And this is why property, I think, is coming back into the fold so strongly, because it's such an understandable and achievable asset class where the yield is very predictable. What drives that yield and the increase in the yield is very predictable. So asset allocation is the strongest point of what we do. Global diversification, you know, you've got to understand the shifts. And just looking at the joke I made, and I made that joke for a reason, just looking at where the trends will be and what infrastructure can support where the trends will be, drives diversification. So you've got a core fundamental portfolio that relies on traditional asset classes, because more wealth has been preserved in land than any other asset class. So it doesn't matter how a person makes wealth, preserving wealth and creating wealth are two very different diversification strategies. So we use all of the asset classes, but also stability and the result that you will get for the risk that you have to take. So that's what's driving the diversification. Time frame, okay, why I like the private equity models that have got both income and capital growth is we allocate a pool of capital, call it a growth fund. We allocate a pool of capital on a high net worth person that has actually no pressure of time on the capital. And that allows you to take these deeper value plays, to allow you to go into properties, because people, they think, oh, when they see 5-year investment, it's a minimum of 5 years to achieve the result. So the right capital has to go into the right pools. And that way, you don't put pressure on the capital to perform. And it's only then that you really get the results out of, you know, fixed property and properties that have to see that cycle play out. So the diversification is, where are you at in the cycle? What is the cost of entering the cycle? An entry point is always critical. You'll never time a market, but you do know the entry point that you're at. So that drives a lot of the diversification strategies that we take on. Anyway, so that's really some of the driving forces.
Brilliant. Thank you, Garth. I want to pivot to you, Peter. One of the things I enjoyed most about the presentation I've done with you, and had the privilege of meeting you face-to-face in Cape Town, but also having done 2 presentations, and like with everyone else, I do try and listen and take out what I think are the most irrelevant parts. And one of the things I enjoyed most about when you presented to our mastermind members was the philosophy of Germany's a big place. And a lot of the institutional capital goes into the 7 major cities, all the kind of the ones that people know, kind of Berlin and whatever. But actually the opportunity lies in the other 40 major cities. Talk to us about that innovative strategy, if you don't mind, because most people, including me, had no idea what you were talking about until you explained it, and then it made perfect sense. And I think it's very important for investors to understand your investment thesis and why you focus on those cities. We'll get to the asset class just now, but why those cities to start off with?
Yep. So I think that's also a big driver as to how we got and remain in Germany in the first place. To give you, context here, Germany's got, say, 7 of the larger cities. Munich, Berlin, Frankfurt, Düsseldorf, Cologne, 1 or 2 others. Now, it's a population of 80 million. Frankfurt's population is only around about 700,000 to 800,000, and it's one of the top 7 cities. So that gives you a good idea just to how diversified the population is within Germany. From a property point of view, that means that your secondary and even tertiary locations are quite large cities with strong purchasing powers. Now, again, we're in the family office space. We can't and don't want to compete with the institutions. Cost of capital with institutions is far lower typically than private equity, family office. So we can't compete in the top 7 cities. But on the other hand, we don't want to be too far up the risk curve and go into locations which could risk and increase the risk profile of the investment. So those secondary locations is very much our playing field. Again, we do need to know that they've got an inhabitation of strong purchasing power, and it's a growing population, which means that we typically in Western Germany, where the growth is, much less so in Eastern Germany, where there's actually a reducing population into some of the Western cities. It's probably 2 or 3 exceptions, Dresden, Halle, Leipzig, but other than those 3, we would typically only stay in Western Germany. Because they are outside of your top 7 cities, they've got a better purchasing, a better pricing entry, and as God said, and I think is absolutely right, profit is often made at your entry point. A lot of people thinking, is it time to sell? Where's the market? Sell, sell, sell. But you can never get out of what you paid for the asset. So if you have the right entry level, that's an excellent start for your investment. And those secondary locations are typically going to give you a better entry level.
Now, there's some brilliant slides that you shared with us, here around some of the reasons on Germany. I mean, you've kind of alluded to this, and then you sort of went into the top 7 cities, et cetera, and then ultimately the asset class. But we'll come through to the asset class now. I'll ask you that question. And just by the way, I've got all your slides, all of you. So if anyone needs slides, just shout, and I can bring them up in terms of the process. Anthony NG, in terms of the risks, I've been talking about data centers, and Alex and I have been talking about data centers to a couple of people over the last couple of months since your presentation in January. There's been a lot of people that have been very excited about it, but obviously it's a new sector. It's one that most people don't understand. What are the risks and how do the risk and returns work in terms of the data centers that you've been involved in?
Oh, thank you for sharing that slide. Yeah, you got everyone's slide, so that's good. That's helpful. Yes, the major risk, the key risk is data center require huge amount of capex. A typical data center deal that we invest in is more than $350 million minimum. So that's the risk. So you want to protect your capex spending. So the way we deal with it is that we want to lock in the client, the paying customer, before we spend the capex. I think nowadays a lot of people, a lot of PE funds and investors trying to get into data centers because it's very hard. It's high growth, but without securing the client. So our approach at Excalibur is we would secure the client and then we will build the suit instead of build and hoping the brokers will bring the tenants or the clients over. Yes, it will be. It's doable in some market where supply is very, very low and demand is very high, but you're still exposed to the risk. So what we did was, and what we're doing is to build to suit the data center. So we will have close to most of our pipeline project, our current project, will have 100% occupancy rate on day one. And we are also focusing on just AI power data center, which will get you higher rental income versus a traditional data center. So we did pick and choose the kind of assets that we designed, so that we minimize the exposure to the construction risk and the market risk.
And tell me, just by the way, you've got a opportunity coming up in Malaysia, as I understand it.
Yes.
Just talk at a high level about that as an example of, what's the opportunity, what's the, why the location, who's the tenant, etc. Just give an example, a real life example of what you just said.
Well, Malaysia is interesting because of the spillover effect from Singapore. So there's a high demand and declining high exposure. It has very, very cheap power costs. It's almost like, I think the power cost in Malaysia is like half of Taiwan. And I think it's like 1/3 of US. So the operation cost saving is already there. We are partnering with the top 3 listed property developer in Malaysia. So they are our local muscle, so to speak. So they will deal with all the government issue, the compliance issue, the permits issue, and they will secure the power for us. So that solves half the issue for us. The investment is to build a 20 megawatts plus 20 megawatts phase 1 and phase 2 data center. Total capex spending would be about 150 million US dollar, and we're looking at very healthy IRR, more than 25% over the period of the investment, and it's 100% rented. So it's day one, the 100% occupancy in that location. It's just the right place, the right time, and then the right partner in that deal in Malaysia.
So that's one. I mean, obviously, Peter, opportunity we're going to talk to you now, but it's actually already on the platform, and that one we're currently in due diligence on. So keep your eyes open. Garth and Anthony, I wanted to ask you, in terms of some of the unique challenges around, and I know I kind of keep harping back on this to some extent, but there's geographic diversification, currency. One of the things that I believe differentiates Calio as an example is that if I'm an investor and I want to diversify, where do I start? Okay, like I want to go to Germany, I want to go to America, I want to go to Asia. What asset class am I going to be in? And suddenly I end up having 20 different partners, 20 different structures. It's an absolute nightmare from a tax and complexity and structuring and everything. And I know, Garth and Anthony, you meet our clients all day long, and that's their life. They've got a house in America and a house in London and money overseas, and there's a cross-pollinization of tax and asset classes and everything. Talk to me, if you don't mind, and I don't mind either one of you talking about, the problems you see that the majority of people have. They've tried to diversify, but it's without a kind of a structured plan, and it ends up just being a complex mess. And then more importantly, what's the better way to do that?
I'm going to let Anthony talk to that, and I'll add in a couple of things around the structuring side and the tax. But I'm going to let Anthony take the bulk of that question, for fear of boring everybody again.
Sure. So one of the common things that I come across is that there's different allocations, like you said, Scott, different geographies, different investments, etc., etc. But there's ultimately a lack of understanding around what that end goal is. And I think that's probably the biggest thing I come across, is that there's lots of different investments everywhere, but the client is not looking to achieve a certain goal. So there's no defined roadmap as to where they're looking to go. So I think when we're structuring and all of that aside, when you strip it back to its core, it's important to focus from the outset on what you're trying to achieve, whether that's wealth accumulation, whether that's wealth preservation. And by understanding that, by understanding the parameters that you need to achieve in order for that to all play out, you can then go back to the portfolio and you can start putting investments in the right boxes. And once you have investments in the right boxes and you have an idea as to what you want to achieve out of those investments, a lot of the things naturally start to fall in place. Obviously, there's that second layer, which I'll let Garth touch on now, around structuring and efficiently making sure that everything's in the right place from a tax perspective. But without that deep understanding of what you're trying to achieve, what that objective is, you're in the dark because you don't actually know where you're going.
I'll just carry straight on from that. Look, I think one of the biggest issues is that people, you know, they heard this term diversification. So they start picking up assets and start buying assets. And the next thing they've realized, they've missed a whole bunch of things. So, you know, you buy an asset into industrial property in the USA, or you just took on a 40% death tax issue in the USA if you're not structured correctly. So the people have bought assets and then in retrospect try and fix up those assets, and that's where the asset consulting side comes in. You know, some assets can be kept, some assets were never right for a person, but it's not about just wiping those assets out. It's about putting them back into the right structures and simple things that can remove death taxes in the USA and UK property taxes and knowing the limits on it. So correct structuring can be very simple. It's not a complex thing. And, you know, the modern platforms, I mean, like yours, Scott, you know, even these things have the ability to remove situs tax because the ownership, the beneficial ownership, is actually out of the hands of the individual. So a lot of the problems we see is dabbling without a plan and having this complexity that's brought in by trying to manage those assets yourself and finding out in hindsight what the problems are in owning a property in the US. If you do it in the correct way and you go to an asset consultant and a family office, a multi-family office, you can understand the complexities of each asset and how to hold that in a structure. And it can be a very simple way and a very simple, inexpensive solution. And that's just not known to the public. I just don't think the global knowledge of being able to diversify on the entire planet really is that available without extreme expense with tax attorneys. And I think that's where, you know, a multi-family office and a community like what we've got here has become very powerful, as people are getting access to information that used to be the domain of the wealthy and the wealthy only. Now you can find out that information through webinars like this.
Yeah. I mean, just at that point, from my own experience, and you guys have helped a lot, you know, a lot of the mastermind members, most of us will go along to our financial advisor and we'll get put in a box, whatever. It might be the PVR box, the Isle of Man box, the Mauritian box, the whatever. And then they only sell you products that can go in their box. So it's kind of like a one-trick pony. And one of the things that I've appreciated about you guys is that you sit with someone in a bespoke way, like you just said, Anthony, and gone, okay, what's your end goal? And maybe you want to immigrate to a country, and what does that mean? And, you know, all of that, and then ultimately help them design their own bespoke solution. And I think that's key, you know, rather than, none of us like to be stuck in a box. So it's very, very important. I will share, Garth, you and I did a great little video. It's only 7 or 8 minutes long, and I'll share it with the participants by email in terms of the difference between a multi-family office and kind of the typical financial advisor, which I'll share with everyone so they can learn. Peter, I want to pivot back to yourself, because, you know, it ties in with what Garth has just said, where, you know, previously I wouldn't even know who you are. I wouldn't have access to deals like yourself. And it's only through the relationship with the family office. And we were kind of starting to talk already about, you know, and I've got some of your slides here about the fundamentals of Germany okay, in terms of where you look. Okay, so we kind of spoke about the cities, and I know there's actually a slide here where you showed some of the big brands that people already understand from around the world, but most of them don't know that they come from little cities, those 40 cities you talk of that no one's ever heard of, basically. So I don't know if, there's this slide that I just wanted to show people, because this was something that I really enjoyed, because, I know all these brands on the left, but I've never heard of these cities on the right, and it alludes to that strategy we're talking to.
No, I think that's quite right. And I think the important point is not only do those big brands that we've all heard about start in those unknown locations, but that all of them are extremely loyal and they don't move. Makes my job quite difficult, because when I go to the head office, if I've got any of these as tenants, I've got a long way to go, and it's sometimes quite far from the larger cities. I'm training and carring around, but that is again getting to the strength of your secondary and even tertiary locations.
So what I want to do is, you've got your fundamentals here, in terms of your investment thesis. And if you don't mind, what I'd like to do quite quickly is just talk through this slide and then go to some actual examples. I'm a big believer in showing real examples. So just talk to the slide quickly, and then we'll go to a real example to explain it.
Okay, I'll be as quick as I can here. Asset class, you've got your traditional office, resi, retail, and then as we're hearing now, we've got the new breeds of data centers, etc., and that's particularly exciting. What we do, again, because we're fairly risk averse, we're defensive. So we always are looking at what's a secondary use. When a building works, it works until it doesn't. So when it doesn't work, what can we do about it? How are we going to work that downside risk? And that's where flexibility comes into play. So, for example, if we're in a mixed use asset, it's quite flexible, and you can convert office to resi and vice versa fairly cost effectively, and you can replace leaving tenants with new tenants fairly cost effectively. So not only does it have to work now, but it has to work going forward in a very changing environment. Unlocking value, well, that's a big part of us as well. We don't want to make sure that the asset class is working. We have to drive the value. And that is, where is your drivers going to be? What is your route to profit? We don't like to leave that to the market. The market has got cycles. Hopefully those cycles can work in your favor if you're strong enough to box through the more difficult times. But what is the management potential here? And that's a strategy that we want to have on day one, and then see how we can realize and execute that. That could be anything from adding floors to slicing and dicing larger floor spaces into smaller floor spaces, getting stronger tenants, a whole variety of things. The only thing we don't do is ground up construction. That's the other side of the risk scale, which we're not equipped to do. So we're not going to go there, but certainly adding floors, refurbishments, buying buildings that do have a lot of capex backlog. Those are certainly opportunities. And to minimize the competition, and that's hopefully where we can differ from a lot of other players. We don't buy from the Jones Lang LaSalle's, the Savills, etc. We may sell through those platforms, but we want to try and get the off-market deals. And that could be because, we're fairly well known in the marketplace. We've got a lot of peers. I know people who have got portfolios that they want to halve off some of the legacy assets, which may work for us, all of that kind of stuff. So that's where we want to work outside of your mainstream competitive base. Anything else you want me to speak around that?
So just in terms of your visibility, obviously you've got a deep knowledge around the location, the tenants, and the industry sector. So let's just take a look here quickly. And let's just go
before you do, Scott, sorry, I did mention that. And again, that gets back to the importance of having, you had local knowledge, people on the ground. Scott, you live in Cape Town or thereabouts. So if I was a foreign investor, I would come in and say, well, I've heard a lot about the Atlantic coastline, and I want to invest there. But as a foreigner, I probably won't be sensitive to the fact that there's good parts of the Atlantic seashore and there's weaker parts. And I won't be able to navigate and know the nuances as to which are the better places to go towards and which are the weaker places to stay around. So that's the type of knowledge that you do want to have.
Yep, no, perfect. And let's just talk to, I don't know, do you want to take case study 1, 2, or 3? I just want to take a real life study so that people can actually see what you're talking about.
Okay, good. Weiblingen, again, secondary location. It's about a half an hour commute from Stuttgart. So I'm happy with my location. If you go back a step just to see the picture there, it's offices. Now, office is maybe not the flavor of the month. You've got to work from home infrastructure. We're very mindful of that. That doesn't necessarily mean that we're not going to do office. Rather, we would look to something like this, which is mainly really medical tenants. Almost all of the office space is taken up by medical tenants, either practicing medically or selling medical products. And there was, as an anchor tenant, a surgery that had a permit, the only one in the city, and that gave a lot of footfall and business to a lot of the other tenants. Then you had a ground floor retail, and what you can't see below street level is the anchor supermarket, which is one of the largest food retailers in Europe. So I've got mixed use. I am in office. About 50% of the building was office, but sticky tenants being medical tenants. And I'm in the jurisdiction, the location I'm looking for. We bought that. There was a lot of capex involved. There was vacancies. We got it for a good price, and we exited to an institution, a strong institution based in Hamburg. So we want to get involved with those assets, which for a variety of reasons, the institutions won't look at. We'll get in there, but the end goal is to try and sell to an institution. Their cost of capital is lower. They can pay the higher purchase price.
Awesome. It's a brilliant way to explain everything you're talking about. So Anthony and G, talk us about some of the strategies. You know, you mentioned that you were in Phoenix for 15 months last year. You know, you've got data centers there, you've got data centers in Asia. I know you've got another location coming up in Japan. Data centers are something that's pretty hot at the moment. What do you kind of, what look at in terms of where in the world to look at and why?
Well, we're trying to avoid some competition with the big boys. A lot of big funds are going into data center, you know. So we're trying to go into tier 2 cities versus gateway city like London and big city. So that's one of our strategies. We're quite busy at the moment, as you mentioned. I think every one of us is 24 hours per day, right? So you're only as strong as your team, your collective team capability. So we always collaborate with a local team. You know, we need the local muscle to deal with power application and the government. So that's how we use to expand our global footprint. You know, unfortunately, I'm lucky enough to have a lot of friends in the real estate network globally from my previous job. So we are teaming up with a gentleman from London to look at our European allocations. I'm in Asia, so I look after Asia. In America, I also have a team of people on the ground in the West Coast in California to help us to do everything from deal sourcing, early technical due diligence, to secure the deal, and then work with the local partners. And another thing that we try to do is to shorten the construction risk. So all our data center can be deployed in 6 to 12 months because we're using modular design. So traditionally, you know, you need 18 months to build a building. So we try to shorten that so that we can expand it. Our paying customer are chasing us to complete those projects because of the tremendous demand there. So as we think about the global expansion plan, speed to market is the key strategy at the moment.
So a good example of that would be that project we're looking at in Malaysia with you, looking to go into the ground in July, sort of completion by the end of the year, earning an income by Q1 of 2024,
Right.
In terms of that process. So I'll come back to that. I'll come back to that in terms of, so I want to kind of wrap up. I'm just conscious of everyone's time here in terms of, so Garth, from your perspective, let me stop sharing that quickly. One of the things that I know we've spoken about on previous webinars is this whole ethical and kind of conscious and even to some extent sustainable considerations in terms of investing. And I know your partner, Nick, talks a lot about this as well. What is your kind of thoughts with kind of where ESG is going and sustainability and everything for us in terms of investors? And I mean, even I know you and I and Anthony have also had conversations around generational wealth and people wanting to do good for their children, etc. What do you see and how does this impact us as investors? You're muted.
Well, the only thing faster than a hoot at a red light is you're muted. The most spoken word in the last 3 years. Scott, like everything, it becomes very catchy and it becomes a theme, and then it loses its substance. But any person who is in investment or preserving wealth and is involved with legacy planning has to understand, okay, number one, impact investing, sustainable investing, and ESG. Right, ESG, which you would have seen on the bottom of that slide there, is a word that's become very prominent in the capital markets and in the institutions. And it's if you don't market ESG, I mean, you're just not current. But the real understanding behind ESG and what the United Nations protocols around ESG are is very much part of legacy planning, because we're not going to leave a hell of a lot behind. Now, I'm not going into the esoteric side of this. It's that if we don't have sustainable investing, okay, the resources will just not sustain the planet. So when we make investments and when we control the flow of capital like we do in a multifamily office, it is our preference to follow the principles, firstly, of ESG, which stands for environmental, okay, social, and governance. So that's the very basics of researching an investment. But now, not to take it to the extreme, you've got to understand what that really means and how it's not profit at all costs anymore. Sustainable investing is going into opportunities, but in a way that can deliver returns that is sustainable to the planet, not sustainable to your income or your requirement. So I think the big gist of sustainable investing, and particularly in Calio, what we do, and with high net worth families, is, it's drafting the family's protocol and investment principles that align with what they want to see and what they want to achieve. A great example, would be Yvon Chouinard from Patagonia. Now, if you look at his sustainable investment goals and his impact investment goals, was donating well over $1 billion to a trust rather than his children. And you could apply to that for environmentally sustainable projects as funding. That's just one example. So this is becoming more and more of a theme. So one of the consulting areas that we focus on is the sustainability and the impact investing through a proper consultation process. Okay, with an Oxford graduate and an actual outcomes based. So I think just talking to the community here, I think people need to become more conscious of what they're investing in and what impact they're having to get the yield. And it's not yield at all costs. And I think that's a responsibility every single investor and every single promoter of an investment has to take on, because we can't follow the process or the path that we have of just endless capitalism. And that's really where I'm talking about these investments. Our partners that we choose, we're conscious of what they're doing and how they're doing the developments, how they're investing, and is that a sustainable asset class? So yeah, that's just to touch on that briefly.
Brilliant. Peter, from your perspective, what I'd like to do is kind of finish off with, we've literally got this opportunity at the moment that called ABBA that you've got in Germany, and it's an exciting opportunity. Yourself and Selwyn have shared it with our mastermind community in terms of the overall process. If you wouldn't mind just kind of talking through, the sort of the high level of why this is an opportunity, why you're considering it. And I know people don't like to mention this, but one of the things that I really appreciate about Peter and his team, they didn't even do a deal in 2023. So their logic of that is they're investors. They're not just out there to do deals. They put their own capital into the deal. Over 10%, of the capital in the deal is their capital. They take on all the due diligence costs. So when a deal's a deal, it's a deal for a real reason. They're not just doing deals, So Peter, tell us, why is this a deal that you're focusing on and looking at the moment?
Okay, first of all, from a location point of view, it's 1A. It's Dortmund and Duisburg, both of which are strong B cities. Dortmund is probably a B+, but in both of those locations, we're city center, we 1A. And typically in the German market, that means you come off the main train station. Every city, town has a main train station. It's a very short walk from there to these assets. Now, it is largely office, again, not the flavor of the month, but given its 1A central location and number 2, highly medical and educational tenants, both of which require permits to occupy those units. Those permits are very difficult to come by, very difficult, costly, and will take a long time. So we've got sticky tenants in good locations, and we're buying this of a fantastic yield. We're buying it from a fund, an Austrian fund. We've done deals with them in the past. It's an true off-market deal. We identified it from them as one of their legacy assets, and we now are able to get it at a very attractive yield. Bit of work for us to do. That's what we're about. That's what we enjoy doing, to max out the value. And hopefully the market will turn around at some stage. Might be next year, 2 years, 5 years, or 6 years. But at the right time, if we've maxed out the value of the property and the cycle is working in our favor, then we would look to sell. We're certainly not scared of selling. We don't go in the maybe the more older school investment cycle or investment philosophy of keeping assets, for a lifetime, etc. We're not an asset management team that just is looking to grow our asset management base and therefore not sell. We're certainly not scared to sell, and I think that's what we've done over the last 5-6 years.
Peter, just 2 things here that I think are important. Obviously yourself and Selwyn, who's Callio Private Equity, who's one of Garth and Anthony's partners, and you and I did a presentation where you went through the entire deal, all the details of the deal. So people can literally go along on the Wealth Migrate platform. They can watch that. They can also go here and they can download the brochure. So all the details, sorry, wrong one. All the details are here, where you can literally go through and read all about it. You can see everything we've mentioned about the German market, and the breakdown of the deal and everything. And so all the detail is here. And I'm super excited. I've already invested in this opportunity. I'm waiting for it to close. But to get in an income producing deal is, with the likes of a partner like yourself, Peter, and your team is really quite a special thing for investors around the world. So anyway, if people are interested, they can literally go read all about it. We can turn the theory of what we've learned tonight into practice, because it's literally there and people can participate. And I always tend to joke with people, but if I literally go along here on the platform and I say, right, I want to invest even as little as $10 and I want to participate, and you've just seen me invest in Germany in not even 30 seconds. in terms of that process. So yeah, that's certainly a possibility for people that want to, partner with Peter and alongside Peter. Peter, just talk to us finally about the timelines. I know that we're getting quite tight in terms of time to get to closing, etc. So, what are the timelines that investors need to be working to?
So we pretty much finalized our due diligence now. We are also in a fairly mature stage of finalizing the SPA, which is the sale and purchase agreement. We would look to sign the sale and purchase agreement mid to end of next month. That is when our deposit, being our management company, puts down a deposit, typically 5% of purchase price. That goes hard, but all the risk is on us. The actual completion, closure, where Judd is at the moment, that typically will happen within probably 6 weeks after we sign. So if we sign, say, mid-June, you look into end of July when we'd look to complete. And that's when the money changes hands. So we would look for all commitments by beginning of July, I would say.
Excellent. Okay. Well, that just gives all of us, we've got a bunch of team members that are online as well, just can make sure that everyone's up to date. Awesome. So Anthony, NG, I'd like to kind of pivot to a final question from yourself, and then Anthony Dinham, I'm going to come to you. I haven't forgotten in terms of it. So I wanted to talk a little bit to Encore, I'm sorry, wrong slide, and not to Encore, to Excalibur. And, the market is an interesting market at the moment. There's changing economic conditions. There's obviously this massive rise in demand for data centers, etc. Talk us through both the pros and the cons of it. And then, also, again, just like Peter's done, give us an inkling as an investor of this $5 billion worth of pipeline you've got coming that we can participate in.
Yeah, thank you. I think we all know about the current market risk. There's a lot of geopolitical issue that we as a businessman cannot solve. So as an investor, we try to kind of navigate around those risks, right? So that's why we're getting into. We used to just invest in traditional asset class like hotels and shopping malls and offices, but we're moving 90% of our investment into critical assets where the demand is there and the return is more assured. So that's how we navigate in this challenging time. It's difficult. Every market has its risk, but we try to deal with the unpredictability with some predictability in our financial model. So you all are aware of the AI impact. It's going to affect every sector of our business, every facet of our life. Our kids they're not going to have the same job as us if they're going to use AI to every extent. And as you know, there's a big election coming up. People joke about the Trump factor in terms of business decisions. What's that gonna do to the dollar, interest rate, supply chain, relationship with China, and everything. So what we're trying to do at Excalibur is to avoid over leveraging, no matter how good the projection of the return is. I think that's rule number one for us. Even in the data centers sector, where we see a lot of growth and a lot of hype. Actually, a lot of hype. A lot of people wants to get into data center. So just to avoid over leveraging is one of our strategy. And like I say, watch over your cash flow. Be prudent, especially in data center where you have a huge capex to spend. So cash flow management, I think, is one of our major planning. And just to borrow the famous famous principle of location for real estate investment. Actually, location is one. For us, location, power, and ESG positioning. That's how you future-proof your investment. We're seeing a lot of green loans, a lot of big funds dedicated, a lot of ESG-specific investment coming to data center. Data center, as I explained, it use a lot of power, but it's probably the industry or the sector of real estate that is 100% committed to green energy and sustainable development because of the problem that we're facing. So in every deal, for example, in every one of our deal, we always have a matching renewable energy solution. If our data center uses 20 megawatts of power, we want to make sure that another 20 megawatts are backed up by renewable energy through solar or natural gas or other form of green energy. So that's how we look at it. We are very bullish on the data center sector at the moment, but we're not blindsided by the potential risk. So that's how we go about in our strategic planning for the next few years.
Awesome. And again, you've got a number of projects coming up. I know that yourself and the team are looking to do due diligence. So ideally, investors should be able to get access to data centers, assuming due diligence goes according to plan within the next 4 to 6 weeks, as I understand it.
Yes, correct.
Awesome. Cool. Anthony Dinham, I want to pivot to yourself. Sorry, I've got to get my slides up. Where have they gone now? Okay, hang on 2 seconds. Why is this not letting me get there? It is. So what I wanted to finish with, Anthony, and just before I go to you, is just to remind everyone that I know Judd kind of was on in the beginning and left, but we're actually doing a deal launch with next Wednesday. So if you want to be part of that, it's a deal launch with him. Peter's very eloquently tonight taken you through Germany and the opportunity and told you the timelines. And if you want to go and watch the deal launch webinar with him, you've actually got that opportunity. But I'm sure that there's many people that sit here feeling overwhelmed. And Anthony spoke tonight, and I think he gave very sage advice, and I think some people might have missed it, which is rather than having a scattered approach, start with putting a plan together, and then once you got your plan, working backwards. And these assets are merely just vehicles to get to the plan. Anthony, I'd love you to talk a little bit around how you help all the mastermind members as kind of your family office practice. And I mean, you call it ALM. I can never even remember the bloody acronym. I just call it a plan. But just talk to me about like how people go from where they are today to getting the, ultimately designing the plan they want and then executing on the plan.
Sure. So asset liability modeling, in other words, ALM, looks at your current assets relative to a future liability or a drawdown requirement against those assets. When we talk about plans, when we talk about roadmaps, what we're doing is we're using this ALM process to understand where you are now, what your existing asset base is, and if you're retired, what does sustainability of that asset base look like, and what do you need to achieve return-wise in order to create sustainability of your assets? If you're not retired, we understand how much time until retirement you have, what contributions you need to make to your portfolio. And again, when you switch to retirement and you're drawing down an income or capital redemptions from that portfolio, what amount of return do you need to generate in order to create sustainability against that asset base? Now, it's crucial to understand that, because the second part of the equation, when we actually start looking at the portfolio construction and we start talking about various different investments, is, like you say, Scott, figuring out where those investments fit within the plan. And when we build those portfolios, we're always keeping our kind of eye on what that original plan was and what kind of parameters we need to target in order for that plan to hold true. That's the gist of it.
Yeah, look, I mean, I always marvel you've taken us through, and I mean, everyone's had access to that presentation you've done on the 6 pillars to wealth. And, we spent the whole weekend with you and some of the mastermind members, where we literally went into those 6 pillars. And I think often in life, people try and overcomplicate things. There's fundamentals. I mean, Peter spoke about the fundamentals. There's fundamentals, and you just stick to those fundamentals. And the reason I finished with you, Anthony, is because I love this little picture. of this young lady that's kind of overwhelmed, and drinking from a fire hose. And I just kind of wanted to say to people, this is how you feel compared to, someone like a Jordan that I brought up right in the beginning, or Victoria. The bottom line is, cohesively tonight, you've met a whole group of different partners. You've met, Anthony from Asia that's doing data centers in both Asia and, well, I've just heard now Europe and in America. You've met Judd, who's doing an industrial in America. You've met Peter, that's doing mixed use in Germany. And then you've got the Calio Capital team that actually is a broad-based multifamily office that can help in not only things like real estate, but other asset classes, including the listed markets, etc., and give you a holistic plan. And so the reason I bring these people up, and the reason I finished with Anthony, is just to give people a sense that you don't have to do it all yourself. Like, you don't have to go out there and figure it all yourself. Tonight, we've tried to share the knowledge with you. We've tried to share access to the partners, and everyone who's on this webinar, can get access to those partners in terms of their knowledge, and, invest alongside them in terms of the process. I'm very conscious of everyone's time. And so can I just ask quickly, if there's a couple of questions that have come through here, and I just want to kind of quickly just deal with them, if you don't mind, and then I'll wrap up. So from Anonymous, it's, when referring to European market, do we consider UK as well? And how do we enter continental Europe as a market or collaborative ventures if they exist? So I'll answer the second part. Well, hopefully Peter and I have just answered that, because you could literally go into the deal in Germany. But for, I don't know, Peter or Garth, I don't know if this is to you, but when referring to Europe, do we consider the UK, or is it separate?
I mean, I'll speak from my side. I'm a one-horse jockey. I am only Germany for the reasons which I discussed. So, I'm sure that UK is also a great jurisdiction, but just not what we do.
And Garth, when you were talking kind of Europe, and I suppose Anthony, you were also talking Europe, do you guys differentiate the UK from Europe, or do you see it as one place?
No, I still see UK as Europe. I mean, despite Brexit and its independence on that side, I still see it as largely driven by the European economy and the.
From my side, from a listed market perspective, I see it as two separate jurisdictions, with two very different sets of rules in terms of the economics that affect each one.
Laurie asked, can any of the investments on the Wealth Migrate platform be incorporated in a wrapper, an example, an Investec or Alan Gray platform? And this is that moment, Garth, where you and I were voice noting today, and I deviate to you. I have no idea, like, is the honest truth. So I don't know if it's even possible.
Completely. Yeah, no, this is 2024. It is possible, but this is actually interesting, talking about the UK versus Europe. It's possible in Europe, not the UK. So there are wrappers, actively managed certificates that can hold any private equity asset that can be pulled into a system like that. So actively managed certificates, yes, there are tax solutions and tax efficient solutions, but more out of the Swiss banking space, Luxembourg, Liechtenstein, rather than the UK. So let's drop Investec from that, because Investec would have to put that through, for example, a Swiss office. So most of these things these days can be listed in one form or the other through a very similar to a wrapper, as this person's referring to. Yes.
I'm going to also jump in there, because it's a fascinating question, and it's strange because it's something that we're working on as we speak. But I'm going to assume that the question is also asked from a South African point of view, as there's obviously reference there to some of the bigger SA list platforms. And the reality is that in the future, we will be able to offer things like this via local endowment structures. So that is something quite exciting that we're busy working on. They do currently exist through living annuities. If anyone's looking for private equity exposure and they have a living annuity already, that is something also that we can explore, but very much at the forefront of developing all of this for a potential South African market. So it's not, you'll ask 99% of the people out there, and they'll say no. But we are quietly in the background working on some alternative ways to access these kind of things through wrappers.
Just a quick one for Anthony and G. I can see he's answered it, but I actually want to just say it for everyone else. Do you think the UAE could possibly look towards data centers in years to come? And Anthony said yes. UAE in the Middle East is certainly a growth area for data centers. Climate is a challenge for cooling, but the availability of solar power can be helpful. So I just thought everyone else would be interested in that. And then equally, Naval asked a question for Anthony. Are you looking at investments in China and India? Surely a high growth economies, there must be great opportunities here. And Anthony said, due to advanced chip exportation restrictions imposed by USA, we're currently not looking at China. We're looking at some deals in India. Just want to talk to that, Anthony, because I know you again spoke about that with our mastermind members.
Yeah. Yes. Yeah. The AI data center require advanced chips, so there's a lot of restriction getting those chips into the data center if you're investing in China. So we're not looking at China at the moment. Things might change next year. We do have a lot of pipeline in there, but we're not making any investment decision at the moment. And China is going to be the largest data center market in the world. But this, for the time being, they just couldn't get their hands on those advanced chips. They are developing their own chips, but because of the pool of investors that we have right now, we are staying away from China this year. India, yes, we are looking at it. It has a lot of potential. I've never done a direct deal. We've done some deals through some partners in India. So it's a market that I'm not currently familiar with, but we are coming up with some, we're teaming up with some local partners in India. So we're looking at India as well.
Perfect. And then Laurie asked a question. It's been asked before, but can governments not force data centers to close? And then what? And you said, are you referring to data centers, data security risk? We work closely with local governments to be their partner, as data centers is a critical infrastructure to a country's digital economy, and we make sure we are compliant in their data security regulations. So right. I'm just reading those out because I assume they actually, good questions often, everyone else wants to know that question, the answer to that question as well, in terms of that process. Okay, then we've done the wrapper one, so I'm not going to do that. Mike Royce asked, question for Anthony Dinham. I have a landlord living off rents. I am a landlord living off rents, but I'll have to wait 3 years before I receive the state pension. I don't have a job. Am I retired?
Yeah. I would classify you as retired, and that's purely because it's not necessarily the literal sense of the word, but you're in a position where you're not deriving an income to make contributions to your portfolio. You're in a position where you're drawing down against the portfolio as opposed to accumulating and contributing.
Excellent. Ian asked, is there minimum capital amounts under management you require before you consider new clients with Calio? This includes family offices, wealth management, and global banking. And God said, no, we do not have minimums. We're geared to provide planning to both creating and preserving wealth. And again, it's, in collaboration, I did reach out to Ian, and I will talk about it now. I'm going to invite our guests to leave if they want to, but I'll actually talk about the collaboration we got with our mastermind, where, that could be very valuable for you, Ian, in terms of that process. And Mike, who just asked that question, is part of the mastermind. Anthony, you won't have met because he only joined 2 or 3 weeks ago. So, you guys can have that conversation as well, in terms of that process. Marina says that we've just described her to a T, so that's the person that's got investments all over the place. But she's also part of the mastermind. So I look forward to you being able to help her bring that all into space. And I know, Anthony, Derek very well, and he said, best learning from tonight is you can't learn to swim from a book. Get it done. Just start, even if it's small. So I think it's quite a nice way to end off in terms of tonight. I deeply appreciate all of you. Anthony, NG, for you, it's nearly 3 o'clock in the morning. So you've gone above and beyond. You get the gold medal for all of us. Deeply appreciate it.
Thank you.
Peter,
I learning a lot from you guys. So thanks for the invite.
It's been brilliant having you here. Thank you. And it's look, it's impossible to get a diversification webinar when you got America and Hong Kong at a time zone that works for everyone. But really appreciate it, Peter. It's been wonderful having you, and you representing Germany, the powerhouse of Europe. And to be honest, and Garth and Anthony have known me for a long time. We've never had Europe income producing assets, up until our partnership with Calio Private Equity. So, I'm deeply appreciative that investors now have that as an opportunity. So thank you for allowing people to participate.
Great, thank you.
Thank you.
And Garth and Anthony, Garth was trying to get out of this today. He was like, the weather's wonderful and I should be fly fishing. So Garth, it's been wonderful having you here. I deeply appreciate the insight from both of you. And the part I enjoy, about yourself is that the other three are all talking about specific opportunities, whereas you've been able to provide the more holistic overview. And that for me is the overall benefit of the partnership with Calio at a mastermind level, because it's not about the individual assets and people trying to make decisions at a singular level, but actually having a more holistic approach. So I deeply appreciate your holistic approach you bring to it.
Absolute pleasure.
Thank you, Scott. I appreciate that. I like the collaboration of this. I just think it's giving access to really great partners and all over the world. I think it's fantastic, and I think it can just grow from strength to.
Awesome. Well, listen, I'm going to bid you all farewell. In terms of if any of the participants want to stay on, I'm going to share with you a little bit about the mastermind and how it works. But for Peter, for Anthony, well, both Anthony's and Garth, have a wonderful evening, and I look forward to connecting.
Cheers.
Bye-bye.
Okay, so for those of you that want to learn a little bit more, if you do want to understand how the collaboration works between Calio and ourselves with regards to the mastermind, we tend to start with a slide and we say, are you feeling overwhelmed? Do you want to be like Jordan and everything that Jordan achieved, or like Victoria and everything that Victoria achieved? And I tend to like to ask a direct question because it's a bit of a game, but it helps you make the right decisions for yourself. So I want to ask you an extremely challenging question. If a doctor came to you today and said you've got a serious medical condition and you have to lose 10 to 15 kilos as quickly as possible. Now, again, I hope this doesn't happen to you, but let's just play along so that you can actually understand this important point. This doctor says to you, it absolutely must happen. You have to lose 10 to 15 kilos as quickly as possible. And you've got two options. The one is you can go home and you can buy a home study course. You can kind of do your workouts. And the second is you can have a coach. And that coach is going to turn up every single day at your doorstep and hold you to account. The question I have for you, and just type it in the chat box, which one do you believe would help you and give you more confidence that you're going to get results? Would it be the home study course or would it be the coach? Tell me what you think. Yep, a lot of people saying the coach. And I think that's the point. So the question I have for people, well, if it was the same for your wealth, and you've just met a number of partners, including Garth and Anthony from the Calio team, wouldn't you want a coach to actually help you get there versus trying to kind of do the home study all on your own? And that's why we focus specifically on globally diversified passive income. Now, for some investors, those super experienced, sophisticated, or even just super confident and self-motivated, we've got just what the doctor ordered. We've built over the years the home study courses to give you the right information and the right partners. So we got Wealth Going Global, which is a 6-module course. I mean, it's effectively my book that I wrote in 2013, endorsed by Clem Sunter, Property Going Global. Why is it not zooming in properly? And effectively, it's the digital upgrade. So it's choosing the top 5 countries, the top 5 currencies, the top 15 assets, how to find the right partners and avoid 80% of the mistakes, and ultimately how to build a plan over time. Or you've got the right partners, where we've gone and interviewed every one of the top asset classes. We've done Anthony NG in data centers. We've done Peter in German mixed use. And all the other asset classes, whether it's multifamily, medical, industrial. We've done Judd in industrial. We've got structured notes. We've got gold. We've got crypto. So all the major asset classes have been represented. And what's important is that this isn't just about learning about the asset class. It's actually meeting quality partners that you can invest alongside. Now, we've proven for over 2 decades that you can do it on your own, but there's a far more effective option. And for us, it's all about building your system, building your portfolio, getting the desired outcome, just like Anthony spoke about. And again, from a coaching perspective, people want to have someone to hold their hand. They want to have someone to mentor them and take them through the process. But, you know, traditionally to be part of a family office used to cost $250 million. You needed, Ian, to answer your question, on average, you needed $250 million for a family office to take you seriously. And we look to change that. And most of you who know me pretty well, how we've done that? Well, we've used technology. Just like Uber did it for taxis, and Airbnb did it for hotels, and Netflix did it for blockbusters, we've done it for this space. You know, for over 20 years, we've been helping people invest. I've been part of coaching programs and masterminds for over 20 years. And we've consistently listened to thousands and thousands of investors as to how they would like someone to hold their hand in a cost-effective way. So we realized that the investment space was broken, and we decided to fix it. We firstly built the 2 home study courses. So you've got WealthE Global and you've got Asset Mastery. If you want the right information and the right partners, it's done. But according to Harvard, you've got a 400% better chance if you work with a coach than if you try to do it on your own. I mean, if you think about it, whether you use Serena Williams, Tiger Woods, Manchester United, the All Blacks, the Springboks, you know, Ray Dalio, it doesn't matter who you are, the best business people in the world, the best teams, the best individuals, all have coaches. And again, according to Harvard, you'll be 400% better off than doing it on your own. But I've been part of a mastermind since 2011. I've been part of multiple masterminds. And I've never been able to understand why a mastermind was actually even more effective than one-on-one coaching. And this video that I found summed it up perfectly.
No, this is extremely predictable. Tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
So, you know, what he said there, I absolutely loved. And if you take the words, humans change 5 times faster in groups than they do with a one-to-one coach. So if you've got a 400% chance, that's 4 times with a coach, and you're 5 times better off than you are with a coach, then according to my maths, it's 4 times 5, which is 20 times. So you're 20 times better off in a like-minded mastermind than you are by trying to do it on your own. But you need a collection of people who are all committed, all driven, and also want to make the right changes happen. And you give them a leader to follow who's willing to get in the trenches with them. All of a sudden, you start to find real, rapid life and business transformation. And so really, you know, if you think people like myself and Alex and the Calio team are prepared to get in the trenches with you, and if you want real, rapid, and life business transformation, then I would consider the mastermind. And the question I have for you is that, you know, people sit here in their comfort zone. And my logic, what I love doing is taking people out of their comfort zone, because this is where the magic lives. And so the question is, do you want to stay in your comfort zone, or do you want to go to where the magic lives? And that's why we created the mastermind. It's about diversifying across countries, currencies, assets, partners, and time. But ultimately, it sits at the middle. Globally diversified passive income. There's 5 simple steps. The first step is that I sit with you. I'm an internationally qualified coach. I sit with you and I help you get very clear on what are your top 3 outcomes that you're trying to achieve. Then you work with Calio in terms of your current starting point. So just like Anthony said, they look at your current portfolio. They look at optimizing it from a tax and structuring perspective. you know, and so it's about knowing where you want to get to, and it's knowing about where you're starting and how do you optimize what you currently have. Then it's about building a plan. I like to call it a simple wealth plan. They call it that fancy ALM, you know, asset listing. I can never even remember what it stands for. Once you got the plan, and most people don't even have a plan, then it's actually about executing on the plan. And that's why the mastermind is a 12-month journey where every month we're checking in from an accountability, a mindset, and an execution to make sure that you actually are getting significant momentum on a monthly basis. And then finally, number 5 is all about the investment. So that's where you're learning from Anthony each month on what's happening in the markets, what do you need to know in the markets. You're learning from the different partners. At the moment, we're doing the Enneagram and Wealth, which is all about, that's it, Mike, ALM, asset liability model. I always forget it. We're doing the Enneagram and Wealth and all about how you make the right decisions when it comes to investing, the psychology, who you are, and it's a 3-month journey we're going on. Generational wealth, it's really an incredible journey that we're on at the moment through this process. We chuck in Wealth Going Global for free. So again, the modules on countries, currencies, assets, partners, and time is all thrown in for free as part of the mastermind. You get access to asset class mastery with all the different partners and all the different asset classes. So you get the right information and you get the right partners. The Enneagram of Wealth is a journey that we're on right now. So if you sign up now, we're building over the next 3 months up to the Wealth Weekend, which is happening at the end of August. So that's something that's really exciting. And the Enneagram of Wealth, a lot of people have heard of the Enneagram, but what I didn't know was that Garth Wellman's wife is an expert in the Enneagram, and they bring that into their family office for their top clients. And it was like, well, we need to be doing that for all our mastermind members. So that's something we've just embarked on and something that we're getting a huge amount of positive feedback for. And so we really had 2 choices when it came to the mastermind. You know, most masterminds around the world in America, you know, are $50,000. We didn't want to charge $50,000 because we wanted people to have, you know, capital to actually invest in deals. If you're in England or Europe, it's at least $25,000. You know, and again, we didn't want to charge that because we wanted to have people to be able to invest in deals and actually get globally diversified passive income. Most people tell us we should be $10,000. And, you know, we are seriously considering it and probably will be moving there in the very near future. But at the moment, we're not at $10,000. And I'm not going to charge you $10,000, but if I was, would it be worth it to you? Just type in the chat box if you think it would be worth it to you. Would it be worth $10,000 if it helped you achieve your freedom goal? Between ourselves and the Calio team, would it be worth it to you if it helped you achieve your freedom goal? Secondly, if it did all of this and provided you peace of mind and you know that you and your family are secure, would it be worth the $10,000? Yes or no? If it did all of this and provided you with a way to protect the wealth that you had created, would it be worth $10,000? If it did all of this and saved you a decade of time, would it be worth $10,000 to you and your family? And finally, if it did all of this, would it provide you with globally diversified passive income and peace of mind? Would it be worth $10,000? And I think when people are honest with themselves, generally it's an overwhelming yes in terms of that process. I know Michael was online earlier. I don't know if he's still here, but I learned a huge lesson from Michael many years ago in 2013, because he came on a buyer's trip and he said right up front, oh, I didn't have the money necessarily to come, you know, to pay the full buyer's trip expense. And him and I haggled over it a bit. And, you know, it was one of my greatest gifts that I was given was that I you know, we came up with something that worked, because Michael went on to not only become a great friend, but ultimately to achieve what he wanted, you know, as a globally diversified investor. And, you know, I'll never forget, he was very clear that he wanted to get income to provide his daughters with the freedom, and they now all live in England. And what Michael said was, when I joined, it was the best money I ever spent and would never have happened if I tried to do it myself. But the lesson I learned from Michael was try and make the onboarding as accessible as possible, because you never know who's going to join and the partnerships and the friendships you're going to grow through the time. So it's far more important to get the right people and to keep it as affordable as possible. So the only constraint we do have is that we can only offer it to 5 people. I work with you one-to-one, Alex Oosthuizen works with you one-to-one. The Calio team work with you one-to-one. So we've got a constraint. This is not a scalable solution with regards to tech. It's a bespoke solution. So we literally have, a constraint in terms of time and the process. So how do you apply? If you're interested in what we've said, literally go along to diversificationmastermind.com and book a call. It's what we call an investor strategy call. It takes about 30 minutes. And what you're going to do is you're going to sit with Alex or myself. You're going to explain what it is you're looking to achieve. We want to understand what you're trying to achieve. We want to explain more about the mastermind and see if there's a synergy. At the end of the day, we're only interested in working with people where there's a synergy. Our job is really, really important to make sure we're getting the right people on board. So there's 3 types of things that we're looking for. The first is, is that person committed to getting that globally diversified income? Secondly, are they coachable? Like, can they work within an environment? Because a mastermind is only as good as the other people. And we've got this incredible diverse group of people from, England, Germany, Italy, Portugal, South Africa, Swaziland, Zambia, Australia, New Zealand. And so we've got this incredible group of people. And so it's very important to create that and to look after that group in terms of that process. And that's what that application call is all about. But equally from your side, it's making sure that it's a right fit for you. If you do sign up, please make sure that you're committed and that you respect our time and your time. So if you do make a booking, please turn up. It's free to turn up and have a booking, but equally, your time is valuable, so is ours. And like I said, unfortunately, there's only 5 places available. So if it does suit you, just go along and do a booking. If you've got some problem with booking, just write in their mastermind in the chat box, and Alex will reach out to you one-to-one. So the average return on investment is 344% from coaching and 700% in business. So for those that are ROI related, it makes a lot of financial sense. And there's plenty of testimonials. If you go to that link, you can go and see all the different testimonials and the videos and everything else. And literally next week, we've got a webinar with real people and real stories. So you can go and learn from real people. We can't guarantee results because it comes down to the individual actually taking action. I can take the horse to water and I can hold it underwater, but I can't guarantee I'll get it to drink. But we do try and guarantee satisfaction. We'll do whatever we can, whether it's the carrot or stick, to help you get, to get the results. And then, back to ROI, I had one gentleman, he had $12,000 and he said, I'm getting 7%. I think he was in Alan Gray, actually. He said, I'm getting 7% in rands in Alan Gray. Would it make sense? And I did the maths. I phoned Anthony. I said, what's your average return? And we agreed it was kind of 14 to 15% on average per year. So I always kind of work on 15. And if you do that maths, over 1 year, and if you invested $5,000 as an example to be part of the mastermind, over 5 years, you would have a 254% ROI. So that's in today's money. You would literally, put in 5,000 and you would get out 12,600. Over 10 years, it would be about $57,000. And over 30 years, it becomes a really high number in terms of that process. So there's a nice little audio clip here from a lady that did the one-to-one coaching with me. And I was fascinated by how much noise people have in their heads and how valuable it is to get that clarity. And with that clarity comes simplicity.
Hi, Scott. This is just a quick fan message. Just wanted to thank you again for our coaching call the other day. And then also wanted to thank you for the brilliant idea of that,
Oops, sorry. What was going and done there?
Hi, Scott. This is just a quick fan message. Just wanted to thank you again for our coaching call the other day. And then also wanted to thank you for the brilliant idea of that, sort of publicly putting in your goals in that Google Sheet. I see that the Google Sheet magically populated itself since the first time I saw it. And I must say the 2024 goals are very inspiring. And it's amazing to see. I found it incredibly supportive to see, people's just the amount of energy and the goals. And it's really inspiring. So just wanted to thank you for that. I really enjoyed reading everybody's goals. I haven't read all of them, but And somehow it's just really helpful. All right, well, have a fantastic day and we'll see you in February. Bye.
I don't know what I just did there, but it's pretty cool. It's literally got whatever is being said below there now. I've never seen that before on PowerPoint. Anyway, Cynthia said, just invested in the Phoenix deal. Thanks for that. Love Judd and his energy. I do as well, Cynthia. And, you know, he was like, Scott, I'm going to be in an industrial building. And I was like, well, you know, again, we're not in a lecture hall in Harvard. Like, we actually, you know, all of these people are doing deals. So I think it's pretty awesome that he was on the ground and he was willing to participate. You know, the other thing that people want to do is look at actually reviewing their portfolio. I mean, a gentleman in England, Steve, had a number of properties. Some of them were cash flow positive, some of them were negative, and we just helped him, you know, look at the portfolio and what he could do. And literally by balancing it out and selling a few assets, he could get cash flow positive he could go from minus £750 to positive £2,000 by doing a strategy. And that's one of the things with coaching often. You don't have the answers, you're just the mirror in terms of the process. You know, Niels and his wife were one of the people that's worked with Garth a lot. And he said it's, you know, they had assets all over the place. And he said it's just so much nicer to have it all together in one place and to have one advisor for all the asset classes. And, you know, to simplify our admin, our tax, and our structures for obvious reasons. You know, and another thing Neil said is, I must say, listening to all the Zoom meetings has made a huge difference in understanding investment options. I don't feel that stupid anymore when having discussions with the likes of Callio and others. Of course, I don't know enough, but at least I can follow their opinions, comments without being completely in the dark. It's so liberating. And then, yeah, just lots of other comments. Mind-blowing, very valuable, extremely enlightening. And then Cynthia, I know you're actually online, but I love what you said. You know, when you said, thank God the mastermind, the partners it brings us, and the exponential learning curve you gifted us. And I know you and I are actually talking next week so people can come and, you know, learn from real people and real stories in terms of the process. And then Abdul's actually coming next week as well. So Cynthia, Abdul, and Derek, I'm looking forward to our conversation next week. In terms of why we believe that you should work with us is that, again, that people have many, many excuses, but often it's, I don't have the money, I don't have the time, I don't have the knowledge. We've built the mastermind to make it as affordable as possible and to help people get the results. We've done it mainly for people that are really time poor, so that it's about condensing time. So in a short amount of time, you get maximum results. And from a knowledge perspective, it's about getting access to the best partners in terms of that process. We also, to my understanding, the only people that do it from a globally diversified perspective. You know, there's lots of companies out there that can take you through the Seychelles and help you invest in medical buildings in America or an apartment in London or a structured note. But there's no one that I know of in collaboration with the partnership with Callio that can give you a holistic view of everything from your pension to your shares on the stock market, to your property investments, to your tax, to your structuring, everything all under one roof and from a global perspective. So whether it's Anthony and G in Asia with data centers, or Judd in America with industrial buildings, or Peter in, you know, in Germany with you know, mixed use. And they're just three examples. There's plenty more. I've spent a fortune on masterminds. So you know, I believe very wholeheartedly in them. $14,000 a year for Singularity University, 25 for Roger Hamilton, 40,000 for Mavericks, where I got to spend 2 weeks with Richard Branson, and also 50,000 with, you know, Tony Robbins to be part of Business Mastery. So why not join over 4,000 investors? You know, wealth protection, plan B, peace of mind, diversification, freedom, global citizen, empower your children, immigration, and ultimately to live a life unlimited. If this is what you want, countries, currencies, assets, partners, and time, diversify across all 5 of them. It's all about creating globally diversified passive income. And just some of the bonuses we'll chuck in. You get priority access to me and Alex and the team. You get access to our tax and currency partners through Callio. You get asset class mastery, wealth going global. You get the Clem Sunter Masterclass, 12-month Wealth Hacker subscription, access to the best immigration agents, access to the Wealth Weekends. Our next one's at the end of August. First access to the buyers trips, and you get Enneagram Wealth, all part of the mastermind. And a final bit of tough love, you know, if I go through this, you know, really what's interesting is that most people, they meet with myself or Alex and they say, right, this is what I've been looking for the last decade, often a lot longer. And then they go talk to their husband, their wife, their financial advisor, their friend, and they kind of, oh, I'm not sure and whatever. And the reason being is that people, it's a new way of thinking. It's a new way of behaving. It's getting access to the best partners in the world. And what I often say to people is that, you know, it's time to take control of your own life. It's time to take MIA, massive imperfect action. This is your life. Nobody's coming to save you. And you got this. And, you know, James Painter went on to say something which is really interesting, because people go, oh, but I need more information, because if I have more information, I'll get better results. But it's actually, it doesn't make sense, because rubbish in, rubbish out. If you've got multiple options, it creates confusion and indecision. Information about the fact doesn't help. You got to get the long-term trend. Well, you can get the long-term trends right and still lose money through buying and selling at the wrong time. So, you know, as we say, it's all about getting access to the right information and the right partners. And if that's what you want, if you want access to the right information, the right partners, then I strongly recommend that you, you know, go to that link, diversificationmastermind.com, book a call with, you know, Alex or myself. And, you know, we look forward to onboarding the right type of people and helping you achieve your objectives in terms of that process. Alex, can you just put the link in there, please, if people want? And Dawn, I did send out, you're part of the mastermind, I did send out on the mastermind group the link to Karen and Bianca, where they'll help you with the Enneagram Wealth. So you just need to reach out to them. If you've got any problems, you know, reach out to Alex or myself and we can help you. Okay, then Cynthia said, looking forward to next week. Me too, Cynthia. It's going to be an awesome conversation. I really enjoy, you know, having, what I love most about those type of conversations is that people think it's only for the super wealthy. And, you know, we're just normal people getting access to the right information, the right partners. And through that, we can start to get abnormal results. Heidi's saying tax structuring with Calio, will it be able to take into account being based in New Zealand? Yes, Heidi. So we've actually got members that are in New Zealand, mastermind members that are in New Zealand. And is there a strategy that is being considered in relation to central bank digital currencies? Sure, good question. We've done crypto, but I wouldn't say specifically central bank digital currencies. I know you've got my WhatsApp, Heidi. I'd love to know a little bit more about that. But yeah, that's a work in progress in terms of that process. Okay, any other questions? I can see in the Q&A there's a couple of questions. Let me just see. Sadly, I do not qualify for the mastermind. How can I find out about what kind of tax structure I need in order to invest on the Wealth Migrate platform? Anonymous, it's quite hard to help you when you're anonymous. I don't know how to help you because I don't know who you are. But in simple terms, look, I can't give you tax advice publicly like this because I've got no idea where you're from and I'm not a tax advisor. And again, you know, when someone says they don't qualify for the mastermind, it's always interesting because I don't know, you know, we meet people and people qualify based on their energy and their drive and what they're wanting to achieve. And so yeah, in terms of the right structure, again, it depends what country you're coming from, but the vast majority of people actually just invest in their own name on the Wealth Migrate platform. Yes, would it be worth 10K? So, sorry, you're answering that question. And then Fulufelo, you said mastermind. So there is the link there. I will take a screenshot of that so that we can follow up, but there is a link in terms of it. Alex has put up the link in terms of the goals. Okay, so Alex is one step ahead of me. So sometimes people say, you know, what are the next steps? What do I do? I'm not sure, you know, should I do the mastermind? Shouldn't I? Well, something that Alex and Shane created was a navigator. So you literally have a digital navigator. You go to the link, wealthuniversity.org/next, and you can see Alex has actually put the link up there. I don't know why, Alex, your link and my link are different. But anyway, the bottom line is that can then assist you know what to do next in terms of your decisions, basically. And let's just see, I want to wrap up here. I just want to remind you, we've got the challenge, our next challenge at the end of July. So that's 5 days. It's 2 hours a day for 5 days. It's intense. It's high quality. We get a huge amount of quality feedback from that. And if you really want to take everything we've spoken about to another level, then I'd highly recommend you sign up for that. It is free. to be part of it. And if you really want to get results, I would join the VIP. It's only $47. And, you know, we find the people that are part of the VIP because they then spend an hour with me every single day afterwards. And they're the people that get the real results. You know, people who pay attention. Then next week, I told you already, I'm excited. We've got real people, real stories, and we can talk through, you know, what we've learned, what's working, what's not working. And, you know, it's the human component to it. So come and join us next week. That's the presentation we're doing today. And in conclusion, if you want to go fast, go alone. If you want to go far, go together. So most people in life are out there thinking they need to do it all on their own. Hopefully tonight you've learned that you can get access to the right partners. And if you want to go far, go together. So thank you very much for your time. As always, I deeply appreciate, you know, it's a long old webinar today. But I just really wanted to take advantage of the incredible guests we had. You know, I've been doing this 20 years and I've never had the privilege of having 4 caliber guests like that from 4 different continents. So I hope you enjoyed it. Mike said in the UK, the best tax advisors have the CTA qualification. Is it CTA or CFA? CTA, Certified Tax. Yeah, you know, that's interesting. So thanks, Mike. And yeah, no, CTA for tax. Okay, Mike. Yeah, perfect. Thanks. So Alex, you've put up the challenge there. You put up the next so that people can click on the links. You know, for me, I think that's everything unless people have questions. If you did enjoy this, please tell other people about it. We will share the recording. You can forward it on to them. And, you know, we are really, you know, trying to add as much value as possible to share the information, to give you access to the partners. And, you know, from my perspective, it's such a unique opportunity for people to get access to information they just never would have had access to in the past. And that is truly one of the things I'm most grateful for. So I hope you enjoyed it. If you did, tell others about it so that they too can take advantage. But if nothing else, if you're South African, go and have a good day of voting tomorrow. I hope you vote for the people that, I probably shouldn't say this. I was going to say, I hope you don't vote for the people who created load shedding. But other than that, have a wonderful evening. Cheers.